Welcome, everybody. My name is Dana Sparks. I am the director of the Georgia Real Estate Academy, which is the school offering this course for CE credit. And today's today's course is 1031 real estate exchanges. And we are so excited and so blessed and honored to have JMangham from Starker Services. And for those of you agents who have been around for a while, you will have heard John's name. He has been doing 1031 tax-free exchanges I've had my license for over 26 years now. And I know he was in the business when I was still selling. So I don't actually interact with the public anymore to buy or sell. I am the broker of Maximum One Greater Atlanta. And so I just broker, teach, and manage. But we're so excited to have John teach this class. He is in Metro Atlanta by far the undisputable expert in 1031 tax-free exchanges. This is a great tool for you guys as real estate agents to have in your arsenal of tools when working with buyers and sellers. So before we get started, I am going to hand it over and have John teach the class. But before we get started, I am going to read the notice to students and the way we are going to handle questions. John's teaching it and I am facilitating. So if you guys do have any questions, please feel free to type them in the chat. And then periodically I will break in so that John can answer those questions. Also, for CE credit purposes, we need y'all's name, license number, email address 3 times. Once now at the beginning of class. If you've already done it, you don't have to do it again. Then when we return from break, and then one last time before you leave the class. So let me share my screen, read the notice to students, and then John, I'm going to hand it over to you and let you introduce yourself and start the class. So let me share my screen. And here is the notice to students. The Georgia Real Estate Academy, which is GREC school number 6915, which needs to be renewed December 31st, 2022, presents to you the following course of study. 1031 real estate exchanges. This is GREC course number 71202 through this school. It is a virtual remote broadcast of an approved in-class course, 3 hours in duration, and approved by the Georgia Real Estate Commission for CE credit. The instructor is JMangham of Starker Services, and there is John's email address. No homework, no written exam. All students must be on time and present for all remote virtual broadcast instruction hours in order to receive credit. And as I just mentioned, we do that via the chat function with your name, email address. And if John does ask any questions, please feel free to type them in the chat so that we do have a gauge of interaction through this virtual process. Students may only receive credit for a specific course number once every 12 months. If you've already received credit for this course in the last 12 months, you are more than welcome to attend, but you won't get extra CE credits. There's no recruiting for employment opportunities for any real estate brokerage firm in the class or on school premises, which is loosely defined in these virtual classes. If so, please let me know. Again, my name is Dana Sparks, and I am the director of this school, the Georgia Real Estate Academy, and Heidi Kelly is the coordinator. That is her phone number and her email address. CE credits will be recorded within 3 to 5 business days. So I'm going to stop my share. I'm going to type in the chat one more time and how to get the handouts if you want them now. But again, you don't need them now. John is going to cover everything. All you have to do is listen and watch the screen. And let me John, I am going to I'm going to make you the host in 1 second. There we go. And then you will be able to share your screen. All right. Mr. Mangham, take it away, sir.
Dana, thanks for that fabulous introduction. I wish I could remember which class it was that you and I met in, but I've taught a few over the years. Quite a few.
It's been a while.
I want to test sharing my screen. Let me just see if this, let's see.
We can see it.
Let's see if that will come up. You
Yep.
should see the first slide.
Yes, sir. We see it. It looks great.
So I want to bump out of there for just a second and get back to the view with all of y'all who got up this morning, relishing the idea of coming to a tax class. Good gosh, on a Thursday morning, what more exciting thing could you possibly do? All joking aside, I've been at the 1031 business for a long time. Obviously, Dana mentioned
John,
that.
we're still seeing your slide.
Oh, let me see.
You just at the top, click stop share. Now we see your screen. Now we see your whole screen. Up at the very top where you will see a little yellow, a little green.
Got it.
There we go. Now we see.
Now we're back. Okay.
Yes, sir.
All right. So I want to say a couple of things, but it's an interesting challenge teaching a Zoom video class when I'm so used to talking with students really throughout the program. And I appreciate that about half of the students have their video on. A few times during the program, I'll ask a couple of questions of the students. And if y'all don't mind, just raise your hand. One of them will be, and I'll go ahead and ask it. How many of y'all are investors yourselves? How many of you own rental property or aspire to? Yep, a few, good. Well, today's program, 1031 Exchanges, Dana suggested I would give an introduction. I forget to do it sometimes. I happen to be a CPA. I happen to be a real estate broker, although I don't sell in any conventional way. And I've been the 1031 guy for several decades. Got involved in my first 1031 exchange in 1988, certainly long before many of y'all had a license at all. And I've seen thousands and thousands of transactions. So my goal today is to bring you 1031 exchanges in a way that will help you in your business. Not to become a qualified intermediary, which is the job that I do with Starker Services, but more so to help your clients and for those of you who are investors, to help you have a good understanding of what Section 1031 is all about, when it's applicable, how to apply it, and how to add value to your clients' transactions. So one of the things that I like to do, because I just fortunately, the things that interested me put me into the world of 1031 a long time ago. But if I could teach this class in 1 minute, and the reason I'm going to go there for a couple of minutes with y'all, if I could teach this class in just 1 minute, I would do so, because I can give you everything you need to know about 1031 in a very short pop, but we can't get credit for that. And so I want to relate it to the elevator speech. Y'all know what an elevator speech is, right? It's when you get on the elevator, and I've seen this happen at a conference. You're wearing your name badge and you're in a suit or something, and somebody says, "Gee, Dana, what do you do?" And Dana says, "Well, I sell real estate. I work for a company called Maximum One," and off you go. So imagine the elevator speech that I've got to come up with when somebody says, and I'll say, we're still at a conference, "Mr. Mangham, what do you do?" "I'm in the 1031 business." "What's that?" "Well, it's a technical tax topic. It deals with investment property." Oh my gosh, people are starting to yawn. So when we talk about an elevator speech, I'm going to give you 1031 exchanges in 4 short phrases. Dana's correct. You don't have to take notes. But if you take notes on anything, I would say jot down these 4 phrases. This will be the basis. This is going to be the framework for y'all having a good understanding of 1031. And this will be something that if you take it and turn it around and you want to use it with your clients. Somebody says 1031 and you say investment property. Somebody's got a rental house. That's an easy concept for anybody to understand. We all know what rental houses are. So when somebody says 1031, what's that? Imagine that I got on the elevator on the second floor and we're going down to the first floor. I don't have very long to explain 1031. And so here's what I say. Number one, investment property. Number two, saving taxes. And when we talk about saving taxes, a lot of people will smile. A lot of people will say, oh yeah, I'd love to save taxes. So we're going to save taxes on investment property in a time period, next two words, time period, and finally, equal or greater value. Those will be the four phrases that will set the stage for this course, as well as summarize this course when we get done. I'm going to break down each one of them. We're going to talk about where they apply and when they apply and how to apply them. We'll talk about some strategies for using those phrases, talking about investment property, and you'll hear the words like kind. A lot of people will talk about 1031 exchanges and they'll say Starker exchange, 1031 exchange, like kind exchange, tax deferred exchange. These are all phrases that relate to the use of an IRS code section, number 1031, that's been in effect for decades and decades. People have been using this to defer the gain on taxes when they sell investment real estate. For purposes of our class, I'll talk about a basic rental house because that's something that everybody can kind of wrap their heads around. If you work predominantly in the residential real estate sector, it could be residential with a homeowner or it could be residential with a tenant. And if you think about the NAR statistics, how many people in this country own their own home and how many people rent, the number varies. It's gone from the high 60s, 69%, down to the low 60s, 62%. But what that says is about 2/3 of the housing stock out there is owned by homeowners, owner occupied. Well, by extension, 1/3, fully 1/3 of the property out there, the residential real estate, is owned by investors, whether it's the big hedge funds, whether it's we call them mom and pop, the small investors who own 1 or 2 or 5 rental properties. But fully 1/3 of the market that most of y'all are accustomed to working in is owned by investors. And one of the strongest and most powerful tools that real estate investors have available if they are selling their property is Section 1031. We call it a 1031 exchange. So again, thank you for letting me come and teach today. Thank you for those of y'all who have got your screens on. It'll be helpful for me when I ask for hands occasionally. And a few of y'all have already said you're investors. So let me ask another question. And again, just a show of hands. How many of y'all have been to, or excuse me, how many of y'all have been involved in a 1031 exchange? Okay, maybe 20% of the room, at least the part of the room that I can see. So let's flip it around. How many of y'all have been to a closing? That's going to be everybody, right? Of course. We know what a closing is. It's when you go to the attorney's office, and I know we don't do that much anymore. Everybody's signing virtually, except maybe the seller who's got to sign the warranty deed. But in the past, we'd go to the closing attorney's office, paperwork would get passed out around the table. Y'all would flip to the top of page 2 and look at the calculation. Y'all know what I'm talking about. You're checking the commission. Fold the paperwork back and say, yep, this is good to go. But all joking aside, a real estate closing is where one party brings the real estate and the other party brings the money. And there may be a lender involved to bring some of the money. And what do? They exchange. The reason I make this example is because I want y'all to realize you've all been involved in exchanging. It's just that you're involved in exchanging in a taxable form, a taxable exchange. Now, if it's a homeowner and they're selling a residence, they have an exclusion. If they've owned and lived in the home for the past any of the past 5 years, they don't have to pay taxes on up to $250,000 or $500,000 of gain. Those should be rules that y'all would be familiar with. But if they're selling a rental property, it's a taxable event. And so the question is, how do we turn a regular closing, which y'all all know about, into a 1031 exchange? And that's going to be the gist of the material that we're going to cover today. is helping you understand how to handle the mechanics and the processes and the conversations around a 1031 exchange. So even though not everybody has been involved in a 1031, because you've been involved in a closing, I'm going to relate some of the elements of 1031 exchange to the elements of a closing. You have a contract, you have a closing, money changes hands, somebody walks away with a property. And what we're going to do is link one closing where your client, I'll refer to your client today, your client, the seller, is relinquishing or selling an investment property, a rental house. And then he or she has got to acquire a replacement. And if we can tie these two transactions together, if we can link them by appropriate documentation and the right procedures and the right time frame, your client can successfully defer the taxes on the gain of the sale of the rental property. So in the market that we've been in over the last, well, especially the last 6 or 8 months, it's been an absolutely crazy market. Multiple offers, properties selling for above asking price on a regular basis, cash buyers. We've probably all seen people coming in from states outside of Georgia. I can't tell you how many times people say, yeah, the California buyer came in and paid $30,000 over asking because they sold their property for so much in California, it was no big deal. And so we're going through this massive reset in the market today. But as a result of some of these price increases, I'm getting a tremendous number of calls from investors and agents who work with the investors to talk about 1031. What is it? How does it work? How can I find replacement property? And there are the jobs that I can do, and there are the jobs that you guys and gals will need to be able to do for your clients. So we've seen a huge increase. NAR would tell us that we are short by some 6 million housing units across the country, and it's created a real over demand or undersupply, however you want to describe it. But we're in this crazy market where it's hard to find real estate. It's hard to win the deal unless you come in with a strong offer. Well, that applies in the world of 1031 exchanges also. And we'll talk about that as we go through the process. So my goal today, and let me see if I can go back to sharing my screen.
John, I've got a question, and I don't know if you want to take a question now or address it later on.
Sure.
The question is, an agent has clients who want to sell 2 properties, invest in his own owner-occupied home, and then do a reverse mortgage on the owner-occupied home. The question is, are there any tax advantages in investing his proceeds in his owner-occupied property to qualify for a reverse mortgage, or perhaps would a 1031 exchange serve him better?
Interesting. So before we get to the mechanics of a 1031, the question is, can I do a double backflip with 3 twists?
Right.
You can do a lot of things. You can sell property, you can take the money and put it into your own house. The question the underlying question that's being asked there, is there a tax advantaged way to sell a couple of properties and put the money into my own home? Unfortunately, the topic today, 1031 exchange, centers completely around property held for investment. And there's a way to sell an investment property, do a 1031 exchange, defer paying the taxes, buy replacement property, and then one day out in the future, let's call it a few years in the future, potentially move into that property. But you can't take proceeds from a 1031 exchange and immediately put it into your residence. A primary residence, a place where you're going to spend a chunk of time, even a second home or vacation home, typically will not qualify for 1031 exchange treatment, because in the world of the IRS, that is not a property held for investment. And no matter that our residences are some of our best investments, you've got plenty of homeowners out there whose homes have grown in value, they're worth more money, and they say, wow, buying that home was the best investment I've ever made. Just because they've made money on it does not mean that the IRS will allow a 1031 exchange to stand up. So back to the question, if you crisscross from investment property to primary residence, you won't be able to defer the taxes. And then once you put the money in your primary residence, if you go get involved with a reverse mortgage, that's a whole nother conversation. That's a financing technique that allows you to harvest some of the equity in your home over a certain number of years. So there aren't any particular tax advantages from the world of 1031 exchange when you cross out of property held for investment and into primary residence. So wish I had a better answer for that one, but unfortunately, no. So let me see if I can jump back into sharing my screen, and let's see if I can get this going. All right, so protecting profits, obviously we're talking about 1031 exchange. I've got a few little graphics just as a technique that I've used, and I've had some people come back to me in classrooms where they say this has been effective. If your client is selling a property and they're thinking about just paying the taxes, have them write a check, literally physically write a check. And I know not everybody has checks anymore, but imagine writing a check to the Internal Revenue Service and just stick that check on your refrigerator, tape it up there and look at that check every day for a week. The thought of paying the IRS makes a lot of people just, they just don't want to do it. And so the question is, do you want to pay the tax or do you want to preserve the profit? With a 1031 exchange, and what we're going to do today, which is, I've set the stage a little bit, but we'll talk about some of the technical rules. We're going to talk about what like-kind alternatives are. And if there's anything that I would tell you is your area of opportunity, your area to work with your clients and help them understand what like-kind is, help them get out of one kind of real estate into another. The phrase like-kind, a lot of people will think, if I'm selling a rental house, do I have to buy a rental house? Not necessarily. When I use the phrase investment property, any real property held for investment under the IRS definition is considered like kind to any other real property. And to put it in a context that y'all will understand, you've got a real estate license. That allows you to transact in real property transactions for other people in any kind of real estate. It could be residential, it could be commercial, it could be hotel, motel, it could be raw land, it could be self-storage, it could be all kinds of things. So when you think about all the things you could do with your real estate license, even if you don't necessarily do all of those things, those are all the categories that will fall into like kind. Again, any real property, as long as in the hands of the taxpayer, it's property held for investment. Obviously, a rental house, it's easy to see that's an investment property. There will be some areas that questions will pop up, and I'll address those. But I've got a couple slides where we're going to talk about like kind, and we're going to drill down into that, because you have clients today, and you have clients that you may get in the future. The day comes after somebody has amassed several rental properties, and they've been running these rental properties for, let's say, 20 years, and they're tired of tenants and toilets and termites. They're just ready to move on. And the question will come, can we sell these properties and buy something else? Could we buy, for example, a pretty property in a nice location, a beach condo, a mountain cottage, something at the lake? And the answer is yes, as long as it's held for investment. And I'm going to explain further what that's all about. So we'll talk about strategies. We'll talk about how you can use 1031 with your clients to help them with their portfolio. And just like my little elevator speech, I will have y'all walking and talking 1031. So when somebody says, will you help me sell my rental property? Your response to them will be, of course. Let me get you some comps. Let's help you get some pricing set on the property. And by the way, have you thought about a 1031 exchange? And they'll say, a 1031, what's that? And I'm going to go back to my list. Investment property, saving taxes, time period, equal or greater. That's what we're going to do today. So again, to say it one more time in a slightly different way, IRS promulgated. The tax code has been passed into law. It goes back to 1913. We actually had a situation in a classroom where one of my associates, Rochelle Stone, was teaching this class, and a gentleman in the back of the room raised his hand. He said, Miss Stone, I like the idea of saving taxes. Does the IRS know you're doing this? And of course, there was a chuckle in the room, and yes, the IRS knows it. Not only do we have the code section, but we have regulations that support it. we have private letter rulings, we have technical advice memorandums, and ultimately we have court cases. And all of this body of tax law gives us a pretty good range of operating within the world of 1031 exchange. So tax savings, like kind, time period. Here on the screen, you see 45 and 180. This will be your first introduction to the time periods. We're going to diagram a transaction, post the time periods, and talk about strategies for managing those time periods. Right now, 45 days seems to go by faster than it ever has because of the kind of crazy market we're in, where there's not enough supply to meet the demand. Finally, the last phrase that I had given y'all, the equal or greater value, you got to spend your equity and replace the debt. We'll set up a little transaction and use some actual numbers so you have a good sense of what your clients need to do. So let me see if I can come back to the screen. I believe I'm back in shape. Y'all see me okay? Just, yep, good. I'm thrilled. I taught a class in your airport location a couple of months ago. We had 50 some odd people on the screen and several people in the classroom. Interesting experience, new for me.
John,
Dana, so far so good?
Just so you know, we've got agents from all brokerages because this is offered through the Georgia Real Estate Academy, not necessarily any one particular brokerage. So we've got agents from brokerages throughout all of Georgia.
Terrific, terrific. Well, I'm glad to be with y'all again. I got a little pop-up. Somebody raised their hand and I'm reading a couple of comments. Thank y'all very much. Was there a question before I jump into the next step? All righty.
Yes, I see. If you're raising your hand, you can, it's best if you just type your question in the chat. That way we have a record of it, number one. And number two, everyone can see it. And we will read out the chat questions.
One of the techniques that I've found that I have to use on a Zoom video, because we don't have the same interaction that we do in a classroom, even if you don't have all the guts of the question worked out, there are a lot of questions that I've heard over a lot of years. And I'll rephrase the question and try to boil it down to its essence so that you know what your client is thinking and really what the answer is.
John,
So,
we do have one question. You said strict period 45, 180 days. When does that time frame begin?
so the 45 and the 180, one of the critical or essential elements of a 1031 exchange, the time periods begin on the day of closing. And while closing can move a little bit, ultimately it's going to be the date that the title transfers. That's the date that the burden of benefits and ownerships transfers from the seller to the buyer. That's the day those two clocks start running. And we're going to diagram that timeline. I'm going to put it inside a transaction. We're going to walk through step by step to make sure it's rock solid for y'all. Okay, let's see if I can go back and there we are. I say there we are. Let me see.
Oh, started from
There we
the
are.
beginning. There we go. We see it. We're good.
All right. So let's talk about how we got where we are today without giving you all of the long, boring history. The world of 1031 exchanges really hit the scene in a big way in the 1970s. One of the big landowners out west, the Starker family, and it's not a coincidence that the name of our company is named Starker. We used the name of their company because it was recognized. TJ Starker and Bruce and Elizabeth Starker, they were one of the largest private landowners. They owned timberland. And they got involved in a transaction with Crown Zellerbach, a large multinational paper company. They were entering into the transaction to sell timberland. And TJ Starker essentially said, okay, I'll sell you this timber, $2.5 million, which if you think about it in the 1970s, that's a really big number. But I don't want the money because I don't want to pay tax on it. And the way they set it up back then, Starker told Crown Zellerbach to purchase property and give it back to them. So Over a period of 5 years, Starker went out in the market and he bought some houses, he bought some more land. He didn't buy it, he had Crown Zellerbach purchase it. They went on the deed and then they transferred the deed back to Starker. And so at the end of the process, he got 11 or 12 parcels in exchange for this big tract of timberland that Crown Zellerbach wanted. They were going to cut the trees and make paper because that's the business they're in. So what happened in the Starker situation, TJ Starker was actually being audited on an unrelated topic. And however the IRS got hold of all his files, they got to his 1031 transaction and said, "What's this?" And he said, "Well, that's a 1031 exchange. I sold my land and I got back these 11 or 12 properties and I don't have to pay taxes on it." And of course, the IRS said, "Yes, you do." "No, you don't." "Yes, you do." "No, you." At the end of the day, they went to court. And believe me, going to tax court is a long and involved process. It can take years before your case will get in front of a federal judge in tax court. But at the end of the day, and the reason we're talking about the Starker case is because TJ Starker wound up beating the IRS. The judge said, if you look at the legislation, if you look at the code section, nothing in the code says anything about time. Now remember, we're in the 1970s. So Starker won on almost every one of his transactions. There are several things that come out of the Starker case that we look to. One is you can sell multiple properties, or excuse me, you can sell one property and buy multiple replacements. By extension, you could sell multiple properties and buy one. You can buy different kinds of properties. That was essentially validated in the court case. But a transaction that did get overturned that forced Starker to pay taxes on one of his properties, he had the title to the new property deeded directly into his daughter, and the daughter was going to live in the house. He thought that would be a good investment. And the IRS said, no, the taxpayer who relinquished a property, TJ Starker, has got to be the taxpayer that gets something back, or there's no exchange. And it's not as if he got the house back and then went through a gifting sequence where he transferred the deed to his daughter. So the IRS overturned one of Starker's transactions. At the end of the day, he paid a little bit of tax. But when Starker prevailed, when Starker beat the IRS, people around the country, real estate brokers, tax attorneys, real estate attorneys, CPAs, started talking about doing a Starker exchange because this was a landmark case in the world of real estate. And people said, well, if Starker did it, I get to do it, and I'll just follow what Starker did. And so people started doing exchanges on a much frequent basis. I've had conversations with, let's just call them old timers, people who have been in this business for several decades. In the old days, people did 1031 exchanges on the large transactions. They had attorneys advising them, they had CPAs advising them, and we didn't see 1031 exchanges on just basic rental houses. But coming out of the Starker cases, there was an increase in 1031 exchanges. More people could do 1031s. It became easier for people to do it. And as we got through the 70s and into the 80s, in the early 90s, we finally got what in the world of 1031, what we refer to as the final Treasury regulations. We got a set of regulations that talk about how you were going to do a 1031. And that's where we got the dates, the timeframes that we talked about a few minutes ago. That's when the 45 and 180 days went into place. The IRS essentially said, we can't let these transactions be open-ended. Starker went on for 5 years. Can you imagine selling something, letting somebody sell something? And what if they went 20 years? What if it just went on and on and on and they never paid the taxes? And then you get into questions about what if people die along the way? It just became too complex. And so the final regulations brought in some restrictions. And the biggest one is the time frame. So that happened in the late 70s. There were some other changes that happened in the 1980s. One of them that we would not typically see in the environment that y'all work in or that I work in. They brought in the rule that said foreign property is not considered like kind to domestic property. This is federal tax law of the United States, 50 states. You can exchange anywhere in the country, but you can't exchange and buy or sell real estate out of the country. Domestic and foreign are not like kind, simply by definition. So fast forward, the next big rule, the next big piece of tax legislation that impacts the business that we do, that y'all do, and that I do, was in 1997. Capital gains tax rate dropped from 28 to 20%. There was a layer for depreciation recapture, and hang on to that. Well, tuck that aside, actually. I'll add that to a calculation here in just a bit. But the big thing that happened in 97 was where we got the primary residence exclusion of 250 or 500,000. And that's a big item that's valuable to a lot of your homeowners who are selling. If they have a profit when they sell their home, they don't have to pay tax on that profit. This primary residence exclusion replaced a section of the tax code. It happened to be section 1034. And if you really dig down into the tax code, you look at the 1030 series, 1031, 1033, 1034, 1035, all those sections deal with and dealt with deferring the taxes. So 1031 is a little bit related to 1034 because it's deferral, and 1034 was primary residence. Again, today we have the 250 and 500 exclusion. What came out of the 97 Tax Act, though, when the act was passed and people woke up and said, wait a minute, if I live in my house, if I own and live in it, any two of the five-year period preceding the sale, then I can exclude 250 or 500 from gain. And the most frequent question I got in 1998 and 99, can I do a 1031 exchange, sell a rental house, buy a replacement rental property, rent that thing out for a year or two, and then move in it? And then if I move into it, can I sell it after 2 years and get out of paying any taxes? For several years, the answer was yes, you can do that. And we had a fair number of people doing exchanges into nice property that they were going to move into after they had it rented for a while. And I know a question that, well, the question came up constantly. How long do I have to rent it before I can move into it? We still get that question today. How long do I have to rent it before I can move into it? Or if it's a vacation property, how long do I have to rent it before I can just make it a pure second home? There's nothing in the code that addresses how long you've got to treat a property a certain way. But if you only rent it for a few months and then move into it, the evidence, should the IRS examine that transaction, the evidence is going to look like you just bought it as a primary residence. Some CPAs would tell you 2 years is a good conservative number. Others would say a year or more should be, and I put that in quotes, should be okay. Unfortunately, there's no chart or table or paragraph that I can point to that says how long. So the conservative position is, if you're going to convert the use of your property, and it relates to this residence exclusion, which came to us in 1997. We've had that now for almost 25 years, but it's still a topic of conversation because it's relevant in the world of residential real estate. So a couple of years is a good number. Some folks are comfortable making a transition after a year. I would say if you do a 1031 and you put a tenant in your new replacement property, at the end of a year, the tenant moves out, you might be in a pretty decent position, but I'd have no basis to stand on that. Okay, so I'm tying together a little bit of what happens in the world of primary residence with what happens in the world of 1031 exchange, because there's crossover. And I don't know if we've got any commercial agents in the room, but even when I teach this class and we're talking and commercial agents say, well, my client's selling a warehouse for $2 million. And I say, well, like kind would let him buy another warehouse or land, or he could buy a residential property. And the commercial guy says, oh, no, my guy's just a warehouse guy. I said, but don't forget, your guy lives in a house. And one of the replacement property opportunities, we'll look at this some more with like kind, but what if he buys a warehouse, a new one for 1.5, and he buys a property at the beach for 500? He sold for 2 million, he bought for 2 million. And so you start to see how these pieces can mix and match in a way, depending on what your client's goals and objectives are at that point in time. So when we talk about relevant tax legislation, you can read what the bill says, you can read what the law and the details say. It's the application of it where creative real estate people, creative attorneys, how you apply this, and the reason I'm spending a couple of minutes here is that the world of Section 1031 very closely relates to your client's personal goals and objectives for later in life.
John,
And this,
we have
yeah,
one question.
sure.
Is it just up to 500,000, or where does the 250 come into play? What happens above 500,000?
Fair enough. While we're on the residence exclusion, and again, because the residence is such a close cousin to the world of investment property. In the world of primary residence, if you buy a home for, let's say, $200,000, maybe you found a good deal during the downturn, and you're married, so let's say you're filing a joint tax return, that's two people, so you each get 250,000 if you were both owners. But let's say you got just a killer deal and you bought a $200,000 house that today is worth $1 million. And that's a big example, but let's go with that for the math. If you sell your $200,000 house for $1 million today, your gain is 800. The exclusion is the amount you can exclude from the gain. So your profit is 800, you can exclude 500. You actually will have to pay tax on the $300,000, even though it's your primary residence. It's not a full free pass anymore on primary residence. The interesting thing is the $250,000 exclusion, or 500 if there are two of you, will take care of the gain in a great majority of the sales. Because what if you bought the property for $1 million and you sold it a few years later for only $1.3 million? The gain is just 300. And if you've got a 500, up to 500 exclusion available, it wipes it all out. One of the things, and as you talk to your clients who are selling their homes, if they have a profit or a gain that looks like it's going to be greater than the 250 or the 500, tell them to start thinking back over the years they have lived there and start collecting information on the roof they replaced, the air conditioner they replaced, the big capital improvements, the kitchen renovation. All of those things can be added to your basis, to your going in price, to shrink how much gain you actually have. So the 250 and 500 work in a great majority of the cases. Interestingly, the folks that we talk to who are on the West Coast, where the California properties sell for crazy prices, they're the ones who are getting hit pretty hard. There's just not enough exclusion available to take care of all of their gain. So one of the questions we get occasionally is, instead of moving into my rental property because I'm going to retire at the beach, what if I move out of my residence and turn it into a rental property? Can I do that? Well, the answer is certainly you can. And what if I rent it out for a year or two? Can I then do a 1031 exchange? And the next answer is yes, you can. And here's the really cool application of these two rules. And I know we haven't gone deep into 1031 yet, but 1031 is about saving taxes on investment property. What if you sell what if you sell an investment property, and for the last 2 years it's been a rental property, and for the 3 years before that you lived in it? Can I still take the residence exclusion because I live there? And the answer, one more time, is yes. So if somebody has a massive gain and they are willing to move out of their house and make it an investment property and then sell it after another year or two, they can take the residence exclusion of 500,000, put it in their pocket, tax-free, and then do a 1031 exchange on the rest. The practical application of that, we don't see that happen very often, but every once in a while we do see it happen. And the short way to describe these two rules and the application is, if you qualify for both, that is, if it's an investment property when you sell it and you lived in it for 2 years during the 5-year period preceding the sale, if you qualify for both, you can take both. So it's an interesting opportunity. In the real world, what we see is people move out of their homes. They don't want to fool with turning it into a rental property. A lot of people have a conception that if I make it a rental property, it's just going to get trashed. That does happen occasionally, but that's not all the time. So the interplay between Section 1031 and the world of primary residence, especially when I've got folks in my classrooms who work predominantly in the residential real estate sector, we invariably go back and forth on these two topics. And my idea is, give you some tools that you can use talking to your clients about how all these things work. Okay, let me bump forward to some more legislation that kicked in 2017. Oh, and by the way, between 97 and 17, capital gains tax rate dropped from 20% to 15%. However, the maximum rate today is still 20%. So if your client's not making very much in taxes, they may be at a 15% rate, but largely if they've got a couple $100,000 in gain on the sale of property, they will trigger the 20% level at a federal rate, not to mention 6% state. So 2017, a couple of more changes sort of brought the spotlight to the world of 1031 exchange. There was chatter in Congress about getting rid of Section 1031. That did not happen. However, it did happen for personal property exchanges. We used to see things like aircraft and boats and railroad cars, things like that, big personal property items that were used in business. You could do tax deferred exchanges on those. Those are gone now. Those are gone. One thing we did get in the 2017 Act was that it enacted immediate expensing, which is to say, if you put a chunk of money in your property, if you put $25,000 or $50,000 into capital improvements, in the old days, you had to set that up on a schedule and depreciate it over many years. Today, you can write that whole thing off. And that provides a bit of a technique for the investors who are doing work to their properties. It helped the people on the personal property side. And then finally, a category that I get questions on, not so much anymore, but when it first was enacted, the opportunity zone legislation came out, and it has some rules that are similar to 1031. It deals with deferring taxes. It's got a 180-day time period. You've got to put your gain into replacement property. So these are some of the rules that transpired along the way. All right, so let me see if I can come back to y'all for just a minute. I want to pause and see. Looks like, Dana, I think I can spot the questions.
A couple of questions. One is, how much do you charge for your services? And one is the tax rate on long-term capital gain based upon your personal income tax rate or something else?
So let me talk about the tax rate first. Long-term capital gains taxes are at a maximum rate 20%. To hit that 20% level, it depends on your other income items. I don't remember the exact dollar amount. I always Google it. I go online and look at the charts. I think you've got to be up above something like $335,000 to hit the 20% level, but you're going to be at 15% federal plus 6% state, actually now 5.75 state. So your other income items, your personal income, can have a bearing on which capital gains tax rate you might fall into. On the question of my services, I'm gonna hold that till I sketch out I'm gonna diagram an exchange. We're gonna put the intermediary in the picture, and we'll talk about that. Let me see. Oh, and the 500 and 250 question. The 250 is if you're just a single owner of your primary residence. It's a personal exclusion. So if I own my house by myself and I sell it, meet the rules 2 out of 5 years, then I can exclude up to 250 of gain. If there are 2 owners, and generally you need to have both owners on the deed to evidence the ownership. If there are 2 owners, then you can qualify for the full 500,000. I would tell you that the 2 owners do not have to be married. Some people would say 250 single, 500 married filing joint, but you can have co-ownership of a house, and each co-owner can take the same $250,000 exclusion.
One more question, and then John, if you'll give me your email address, I'll type it in the chat so everyone can write it down and contact you after class too.
Sure.
The question is, investors buy, fix, and sell. Can the proceeds from the profit be put into a like-kind property?
So when we talk about buy, fix, and sell, the starting point for this, I want to take you to people who are running big companies, builders, developers, Pulte, D.R. Horton. Those are the big guys. They buy land, they carve it up into lots, they build houses on the lots, and they sell the houses. Those lots and that land and those houses are considered inventory. When you get, let's call it the two guys, two gals in a pickup truck, and they say, let's go invest in real estate, let's buy a fixer-upper. We'll be investors, we'll fix it, we'll sell it, and we'll make a profit. And I get the question from those folks, can I do a 1031 exchange? If you're engaged in a trade or business, if you're engaged in home building and doing development work where you take a piece of land and split it into many, many lots, 1031 doesn't work for those businesses where that real estate is your inventory. So just because it's real estate doesn't always automatically make it qualifiable for 1031 exchange. By extension, if you're doing a fix and flip, if you buy a house for 150 and you put 30,000 in it and you sell it 3 to 6 months later, whenever it sells for 225, you make a profit. The IRS would consider that to be earned income. The profit on that sale came as a result of your efforts, either in contracting or if you did some of the work yourself, painting, swinging the hammer, doing the plumbing, whatever it might be. Technically, 1031 would not qualify if you're in the fix and flip business. Now, to parse this a little bit, I do have clients, I get calls, and we do 1031 exchanges. You can do fix and flips, and let's say you've got a little entity over here that fixes and flips a couple of houses a year. You can also have on this side property held for investment, and that's your rental portfolio. This is that stuff that's going to pay you while you sleep, that good long-term hold rental property with hopefully good positive cash flow. You can be involved in both kinds of property, but the fix and flip stuff is going to generate profit that gets posted on your tax return. The held for investment, the rental house, when you sell the rental house, you can do a 1031 exchange on that because there's no question that that qualifies. Your tax advisors, prudence would say, keep these operations in different entities, run the fix and flip business, or at a minimum, keep them in separate checking accounts. So you don't intermingle. What you don't want to do is have the IRS question you on a fix and flip, and then all of a sudden look at your whole list of several rental properties and say, oh, well, those aren't going to qualify either. So keep those two kinds of businesses separate. And then for those of y'all who sell real estate, you've got a third kind of business, and that's your operating company. Y'all already know this, but you've got a cell phone, you've got a computer, you've got board dues, you've got things that are associated with the commission income that you earn. So in the world of real estate, you are really operating, or you can be operating, three different kinds of businesses. So the investors that are doing fix and flip, generally their transactions are not going to qualify.
If you'll give me your email address, and then the next question, I believe, is continuing on with your presentation. The question is, can you speak to the actual participation requirements, interaction with closing attorney, so forth and so on, agent from contract to closing? And
yes,
that gets into the exchange agent that John, I believe, is going to address next. But John, go ahead and give me your email address so people can write it down.
Thank you, Dana.
Yes, sir.
My Starker email address is first initial J Mangham, MANGHAM, at Starker, STARKER.com. And just as we talk about some things today, we've got material. I know Dana posted our brochure, which is kind of a quick read on exchanges. There are some other flyers that we make available on like kind and very reverse exchanges, various topics. You're welcome to shoot me an email if you think of something and just say, hey, could I get some more information?
And I'll post the link to that Starker brochure as well.
Terrific. On the question, I believe Bobby posted the question, the participation and requirements and interaction with the closing attorney. You're throwing me a softball because I'm going to diagram an exchange in a few minutes, and I'm going to put all the players on that slide. So hang tight and let me do it when I've got a diagram up, and then we'll take all the specific questions and roll them in there. All right, Dana, it looks like we've got a question related to the fix and flip with two guys or two gals or whatever, whoever
If you
owns
have
it.
two gals, two guys on a fix and flip, all with different personal incomes, how would you determine the estimated tax rate? Would it be 4 individual rates or 1 rate for all 4 people? And
So-
another question, this may be somewhat off topic, but do you have any helpful suggestions to help on reducing property taxes after turning a primary residence into investment property to help offset the increase in property taxes after losing the homestead exemption from that property?
Oh, that's a good one too. So because we were just talking about the fix and flip business, if you've got several people who go in together on a fix and flip transaction, and in its simplest form, we would just put several people. I'll use Dana. Dana and I went into a deal together and we bought a fix and flip and we just put our names on the title. We're going to keep it simple. When we get done, let's say we made $40,000, Dana gets 20 and John gets 20. The tax that I pay on my share is going to be based on everything that's inside my personal tax return. So if I have other income and if I have a big income, my tax rate could be higher or could be lower than Dana's. So the tax rate would be different for different people. A lot of folks who work on fix and flips do them inside entities, but the entities are typically pass-through entities like LLCs, partnerships, and sub-S corporations. When you pass the profit through to the partners, again, it's going to be each partner at their own individual tax rates. One thing I like to suggest, whether you're going to be doing fix and flips or rental property, I always encourage folks to keep their CPA or their tax preparer in the loop. It's like going to get a checkup occasionally. Find a time during a non-busy, April 15th tax time of year, and just spend an hour with your CPA and pay for the hours of time, but talk about what you're doing. I'm going to work on a fix and flip, or I'm going to work on rental property, and get some coaching on the front end. That can be valuable to you as you grow your business. And that, of course, will leads into the tax rates. Quick answer on what happens if I convert my primary residence to a property held for investment. I lose the homestead exemption, which means I'm paying more property tax. The people that I know that are heavily involved in rental property, they keep a schedule of all their properties, what the taxes look like, what the values look like. And I would set up a relationship with a property tax consulting firm to appeal my property taxes every year. These companies can generally do a good job helping to keep the values as low as possible. You can do it yourselves, but it's a question of, do you have time? And after you've got 3, 5, or 10 houses, it's hard to keep up with all of that. But I would appeal property taxes, and I would always be looking for comps that, if I'm looking for low value, I'm looking at the low end of the range on comps. But otherwise, it's just a process of managing your rental property. Okay, I'm going to go back and share my screen. Let's see if we can jump back into some material. Let's see, about to get this sequence down.
Nope, from current slide. Oh.
You're right. Okay.
There we go.
So, whoops. Not as easy as when I'm in the classroom. Okay. So let me jump into the capital gains tax calculation. I'm going to jokingly say, everybody put your pencils down. This is not something that you want to do for your clients. Now, you're welcome to take all the notes you want, but let's talk about how we look at the scope of the problem. Let's analyze what the capital gains tax would be if we're selling a property. Two things happen, or at least we hope this happens. We buy a property and it grows in value. We know that's called appreciation. But in the world of rental property, we also take depreciation deductions. And so they are diverging as time goes by. I've got a little timeline across the bottom. So let me layer in some dollars. If you look to the left side of this slide, and I know I threw a bunch at you. if you talk to people about too much material on a slide, this one's going to qualify. But let me break it down. Here's our appreciation and depreciation wedges. Appreciation is the growth in value. Depreciation is a tax benefit. You get a deduction every year. So look to the left where it says original basis. Let's say we bought a rental house for $150,000. And today, look above that, we're selling it for $250,000. Your profit's 100. And your client might well say, hey, I'll just pay tax on the profit. I heard capital gains was 15%. I'll pay 15,000 and go on down the road. And I want you to say, before you sell the property, please talk to your tax advisor. Please talk to your CPA and make sure you have a good feel for what the taxes could be. Because the other thing that happens, if I had the pointer, I would point, the original basis of your property at 150, over the years you've owned it, and this really applies to the people who bought property during the downturn. The downturn started over 10 years ago. And it's easy to say that I bought it for 150 and I've taken depreciation deductions. My accumulated depreciation, go look to the right side of the red depreciation wedge. I could have taken 50,000 in deductions, which sheltered my income from taxation during all those years. But that makes my basis, my adjusted basis, again, back to the left, 100,000. And the reason I'm going through these calculations, I want to show you because we've got to pay tax on the profit of 100 and also on the depreciation recapture of 50. Here's the way the math works. And if you hit the top tax rate, the 20%, looking across the bottom of our slide now, federal tax on the profit, the appreciation, 20% is 20,000. The depreciation recapture is statutory at 25%, 12,500. And then you've got state income tax. I use 6%. Georgia's gone from 6 to 5.75, but 6 is a pretty close average for across the country. There's another 9,000. And when you look at this in the blue box in the lower right, your total tax bill isn't just 15,000, it's above $40,000 potentially. And so on the sale of a $250,000 property, people look at that and say, well, maybe I'll just pay the 15. As an agent acting in their best interest, you don't want to do this calculation for them. You just want to tell them to check with their accountant, check with their CPA, and make sure they have a good feel for what their tax liability would be. And a lot of times they're going to come back and say, do you know I've got to pay more than $40,000 in taxes? You can nod your head and say, oh yeah, I've heard some pretty big numbers, because you've had the property for some years, you're making a profit, and they're going to say, that's crazy. I don't want to sell the property. And I've had this happen in a classroom too. An agent lists the property for $250,000. The next day, client calls back and says, I can't sell it. I've got a $41,000 tax bill. The agent says, well, why don't you consider a 1031 exchange? And the client says, what's that? And you guys know where I'm going to go with this. It's about saving taxes. I can help you save $41,000 in taxes. How would you like to be the messenger delivering a good news message, telling your client that you can help them save over $40,000? And they're going to say, how do I do it? Well, let me tell you about a 1031. And again, the 4 points: saving taxes, investment property. We're going to look at a couple of pictures in a couple of minutes. So this tax calculation is not intended to have you all doing, crunching the numbers for your client. It's really intended for you to see just how big the tax bill could be. And I know some of your clients, some you like better than others. That's the nature of dealing with the public. But some of your clients are going to say, 250,000, you're going to charge me how much to sell the property? And obviously they're referring to your paycheck, your commission. Well, if you look at the total tax bill versus what the commission might be on a transaction at 250,000, aren't you in a position to help them save more than 3 times what a commission would be? And so their focus changes on what is potentially the biggest number in their transaction. It's not on everybody's, but the point is, be sure that your client has a sense of what the tax liability would be before they enter into the transaction, before they get to a closing. Because once it's closed, if you haven't started a 1031 exchange, if you haven't put the mechanics in place and the paperwork in place, if you walk out of that closing room with the check, it's all over. It's all over. So it's important to know what the tax liability looks like. And this is kind of a dramatic example, 41,000 on a $250,000 sale. That's not a huge property. It's just not in today's world. Okay, let's solve this problem. Let's solve this problem, and let me just kind of, I'll put it this way. I'll bring up the dry and boring slide. This is the essence of Section 1031. This is what you'll find if you Google it and read the IRS code. No gain or loss shall be recognized on the exchange of property held for productive use in a trade or blah, blah, blah. You already start to lose ground on this because it's just a bunch of words. I've highlighted what's important, and it says investment exchanged for investment. And we've started to build around like kind. We're already talking about the fact that residential and commercial and different properties are alike in the world of 1031 exchange. This is the paragraph that gives us that. It does not say investment, or excuse me, it does not say rental house exchange for rental house, raw land for raw land. It simply says property held for investment exchanged for other property held for investment. And to put that into pictures, you literally, and this is where people sit up and some will sit up and take notice. You can sell improved property, which is dramatically different from unimproved agricultural property. And for the IRS, that's considered like kind. And I've had situations where somebody says, I've got 3 rental houses, and the last thing I want is another tenant. It just hasn't worked out well for me, but I'd like to buy a piece of land. Can I do a 1031? And the answer is yes. Rental property, excuse me, rental house, rental condo is like kind to raw land, is like kind to commercial building, is like kind to an apartment building. And you can see we can get into the different categories of commercial property: office, multifamily, warehouse, self-storage. All of these kinds of properties are considered like kind to each other. And so you could sell an office building and buy multiple rental houses. You could sell land and buy rental houses. You can crisscross on this slide literally any way you want. And then another way to crisscross and to look at what like kind can be. And again, your area of opportunity. This is where you can bring some real value to your clients. And we'll talk strategies related to this. In this slide right now, we're looking at single properties: 1 rental house, 1 piece of land, 1 office building. But what about a fractional interest in real property held as tenants in common? And I'll bring Dana back in the conversation with me. Instead of doing a fix and flip, what if Dana and I had purchased a rental house 5-10 years ago during the downturn, and we go to sell it, and today Dana wants to go one direction and John wants to go another? Can I sell my 50% interest held as tenant in common and do a 1031 exchange? And y'all are probably starting to catch on. The answer is yes. I can sell my interest in real property, do a 1031, take my half and go buy something. Dana could sell her half and do her own 1031 and go buy something else. Or she could take her half and cash out and pay tax on her portion. So when you look at the fractional interest, you start to get into scenarios. I've seen this one a lot, where relatives, families, somebody inherits property, the siblings inherited property 10 years ago, and today they want to sell it because it's gone up in value dramatically, but they don't all want to stick together. And the 4 siblings are unsure what to do. They're talking to their CPA, they've got a big tax bill, and you come along and say, have y'all considered a 1031 exchange? And they're going to say, what's that? And of course, you're going to give them the quick, easy answer, because it just opens the door for them. Once you've said 1031 and they get their head around what it is, you're going to be talking to these 4 kids. And I'm making up the example, but the 4 siblings who own this property, that maybe it's a piece of land and a developer wants to buy it. So these 4 siblings, the first one says, oh yeah, I'd like to buy some rental houses. Can I do that? Yes, you can buy rental property, even though you're selling land. Yes, you can sell a fractional interest. So the second person, who lives out in Portland, Oregon, says, Well, I don't want to buy anything in Atlanta. I want to buy something in Portland. Yes, you can do that. It's federal tax law. The third one says, I got to have the money. And yes, you can do that. You can cash out your share, take your piece of the money, pay your piece of the tax. So each person can choose different paths. And all of a sudden, the four siblings who couldn't come to an agreement get to make their own choices. Because don't you know, several of those siblings likely have somebody else in their life, a husband, a wife, a partner, whoever, who might be suggesting something that's inconsistent with what the other siblings want. And the fourth sibling, he or she wants to buy the sports car and drive off and see the rest of the country. He or she can do that. So when you're talking about like kind, and when you're talking about liquidating investment property, and there's a profit and there are taxes, consider not just the transactional approach. Yes, I can list and sell the house. I'm a licensed agent. I've got experience. I know the market. You guys can all do that. Consider the impact on your client's life, because if you can help them save the taxes, and in some cases, help them acquire replacement property, that may put them in a better position down the road, because the tenant, or excuse me, the owner who wants to own tenant occupied property, looking for cash flow in the future, somebody's got to help them find that replacement property. And if y'all aren't seeing it yet, you will when I diagram it. If you get involved in 1031 exchanges and your client is selling a rental house or selling a piece of land or a fractional interest, and they do a 1031 and they buy replacement property, y'all are going to have to help your client with two transactions. And I know Dana doesn't want me to say this, but if you're involved in two transactions, you're going to get two paychecks. Y'all are grinning, I get it, or I hope you are. The idea here is it's multiple transactions. You've got to help your client with multiple activities. But in the case where your client stays invested in real estate and uses some of the IRS's money to stay there, you are helping your client with their life on down the road. And when that happens, who's going to call you back one day in the future? I've been in this business for 30 plus years. 2 months ago, I got a call from the woman who was the very first 1031 exchange I did in 1988. John, are you still doing 1031s? Oh, yes, ma'am. Sure are. Well, we're selling this property. And so if you work with investors and they stay in the game, you're talking about adding elements of a very long-term relationship. So like kind is extremely broad. It's anywhere in the country. It's any kind of property. It's fractional interest. It's multiple interest. It doesn't matter what kind of zoning may be on the property. Zoning is a local municipality function, and that, of course, can change. But as long as it's held for investment in the hands of the taxpayer, you can do a 1031 exchange. All right, I'm going to come back on the screen for just a minute so I don't just bore y'all with all the screens.
John, we've got a lot of questions.
I love that everybody's engaged. Thank you.
All right, I'm going to read through them, and then if just let you keep track of them, and then if I can read back. Do you have any suggestion for a good property tax contest company? I'm not sure what that means.
Oh, to contest your property taxes.
Oh, gotcha. Contest. Okay. Do you access depreciation every year against other income, or only at the time of deed transfer representing the total amount of years of ownership?
Okay.
Can we access any of the profits for personal use, or must the entire profit be rolled into the 1031 exchange? Is the federal tax depreciation a tax always 25%? No, you guys, that's going to change by administration vote. Would it be strategically advantageous for the siblings to form an LLC for that example, or would it make any difference? And if they didn't have separate plans for the proceeds or an estate sale? So that was a long laundry list of questions.
I'm glad to see that everybody's engaged, and what happens, not that y'all are all going to tell me in your specific cases, some of y'all are already thinking about clients that you're working with and who you're going to call when you get out of today's class. It's not uncommon. I've had it happen where I get a call this afternoon or tomorrow. Hey, I'm talking to so-and-so. They were in your class yesterday, and they just need some more information. Let me try to zip through these reasonably quickly. Good property tax consulting company. I don't have a specific suggestion. I work with a group called Property Tax Consultants, but I would Google them, and I would look for people who work in the area that y'all are in. Although they can do this all over the country, they seem to be better if they're in the area, like in the broad county or metro area. Question on depreciation. Depreciation is a deduction you take inside your tax return every year that you own your real estate. So if you have a rental house that makes $1,000 a month, 12,000 total income, you deduct interest expense. If you have a mortgage, you deduct advertising if you paid some advertising, and you get a depreciation deduction. And that happens every year. So it reduces your income tax every year that you take a deduction. Can you access profits for personal use? If you take profit out of a 1031 transaction, the IRS is going to tax that profit. So you could take, let's say you're selling a rental house and you decide you want to take out 10,000 or 20,000, you can do so. However, you'll be paying tax on that money, and the IRS will deem it all to be part of the profit layer. So before you do that, you want to be sure you know what your calculation looks like. Federal depreciation recapture tax, 25%. It's hard to know what Biden's plan is going to land on. That has the potential to change. Capital gains has the potential to change. Right now, the smart people in this tax arena are suggesting that there's still going to be a lot of negotiation and debate before his plan gets put into play. So it's hard to know where that's going to land. Back to the siblings. I use the scenario of the siblings who own property together, because y'all know people who own property together, whether they're siblings or just co-owners or partners. Should they form an LLC? I wouldn't necessarily suggest that forming an entity would put them in any different position. An entity like an LLC is used a lot of times for liability protection and privacy, but it won't necessarily change the tax treatment of what happens if they sell that land and do or do not do a 1031 exchange. So I would say if the group of siblings is sitting on a property and they're not already inside an LLC, it probably doesn't make sense to go down that path. Let's see, I think that hits the high spots on the questions. So there's one more category, and it's not really a category, but in the world of like kind, a question that I get frequently, and I've alluded to this, I'm going to go back to it, but I want to talk about it for just a minute. If I'm selling a condo, or excuse me, I'm selling a rental house in Atlanta or a rental condo or townhome, y'all are seeing by way of picture and conversation, you could buy a piece of raw land, you could buy a commercial property, you could buy a fractional interest. Every once in a while, somebody says, can I sell a rental house? I've got a buddy who's buying a commercial building. Can I buy a portion of the building? Sell the rental house for $250 and buy a 25% interest in $1 million building? Well, the answer is yes, that could absolutely work. But the question that I see frequently is, can I buy a property at the beach and then can I go down there and stay in it? And I want to take you to the vacation ruling back in 2000. Let's see if I can do this. Am I from current slide? Woohoo, got it. So we had our different types of properties, but the question about vacation property. In the early 2000s, we had a real hot go market, 2002, 3, 4, 5, even 2006. And people were doing 1031 exchanges. They were selling property in Atlanta, buying property at the beach. And in some cases, they weren't renting it out at all. But the market was so blazing hot. You remember the term pre-construction contracts? People were putting properties under contract, flipping the contracts. And everybody was saying, what a great investment. I made all this money. We were seeing lots of 1031 exchanges on property that was really personal use property. It was never intended to be a property held for investment. It was a property that somebody was going to use personally or let their family stay there. And the IRS caught on to that. and they came out with a vacation property safe harbor revenue procedure. That's a lot of words. Basically, we call this the vacation property ruling. And the IRS says a dwelling unit, let's think of this as a condo or a cottage in the mountains, held for rental income, also used personally, meaning you're going to go stay in that property some of the time, will qualify for like-kind treatment, will qualify for a 1031 exchange, even if used occasionally. And everybody's going to say, what is occasionally? There's a 2-year period where these rules apply. You've got to rent it at least for 2 weeks a year for each of the 2-year, each 1 year, each 12-month period for the 2 years preceding and following the exchange. So if you're selling a rental property in Atlanta and you want to go buy a property at the beach, well, the rental property in Atlanta is like kind, no question about it, because you weren't using it personally at all. So all you have to do is match the rule after you complete the exchange. If you buy the property at the beach, you've got to keep your use minimal, which is down in the middle of the bottom half of the slide. You can use it for up to 14 days for each year of the 2-year period following the exchange. And then there's a little bit of an extension, if you will. Look at the very bottom, the maintenance exception. The days that you spend working on the property, painting it, building a deck, doing things that you might do for those of you who would work on your property, don't count as personal use days. And the text in the IRS documentation further says, even if the taxpayer's spouse is not so engaged. And what that means is, if I'm painting the condo and my wife has taken the kids to the beach for the day, they can go vacation all day. And because I'm maintaining the property, it does not count as a personal use day. And that's something that'll let you stretch the 14-day period. There's also the 10% of the total number of days rented component. And what that means is, let me build an example. You rent your vacation property to a snowbird for 6 months, 180 days, let's say. Plus you rent it during the high season for another 10 weeks, 70 days, total of 250 days rental income. Great performing property. That would say you could use it for 10% of 250 days, total of 25 days, which gets you more than 14. That's a little tricky to manage, because what if the snowbird that has it booked during the second half of the 12-month period doesn't show up? I've found most people just say, I'll keep my use to 14 days, because at the end of the 2-year period, once we get past the 2-year safe harbor period, you've met the safe harbor. And you wake up on the beginning of year 3 and say, I don't want this to be a vacation property anymore. I want to retire at the beach or mountains or lake or golf or wherever it is that you might decide you want to buy a vacation property. So this vacation property ruling, if we go back to looking at like kind, it absolutely allows people to manage their portfolio, sell the rental house, buy the vacation property, or sell a portion of a property they own, buy the vacation property, use it a little bit for 2 years. Just watch your use for 2 years. And at the end of 2 years, you can wake up and change your mind. You can move to the beach. You can make it a pure second home and take it out of the rental program. You really have the opportunity to do whatever you would like. And the way I like to look at 1031, and then the way y'all would apply 1031 with your clients, is you're giving your clients the power to use the IRS's money to help them with their personal portfolio and therefore their personal lives. And if you can help make their lives better and their portfolio better, y'all are going to get the credit for bringing the idea to them. Okay, let me jump back out. We're splitting our program today into 2 segments. We're going to be coming up on a break. If there are a couple of, couple of questions before we take a break.
One is change those paint colors often.
Let's see. Dana, I think I can see these. Yeah, I'm selling a rental, which I am living in, to complete repairs to a home for rental investment. Also buying land to build my new home. Can the proceeds be used for both? Be considered for a 1031 exchange? If you're living in a property temporarily while you are working on your own home, yeah, I would have you talk to your CPA. You get into all kinds of questions about how long you were a temporary resident in your rental property. If that goes on for months, you really have, maybe not legally, but practically, you've changed your primary residence. I would have you consult with your CPA on that one. Also buying land to build a new home. The land that you build, the land that you buy to build your new home, again, because it's your primary residence, that land is not going to qualify at all in the world of 1031 exchange. And the proceeds from the sale of the rental property won't work if you use those proceeds to build the home that you ultimately will live in. If that transaction, if you did a 1031 and that transaction were to be examined, audited, they would have no problem overturning that 1031 exchange. And the penalties associated with a failed exchange, they can be really pretty steep. Let's see. I think there was another question. Dana, did I see one other question?
Yeah, sorry. Selling rental, complete repairs. I think you got that one.
Got that. And then email the slides.
Yeah, those
Dana
are, I just
Yeah.
put, the link is the slides. The handout is the PDF of the slides. And that second link is to the Starker Services brochure. I also have John's email address. I think I put that in there. Yes.
Okay.
All right, let's take a break. I've got 11:27. Let's come back at 11:45. I will launch a poll that will be the CE course evaluation. When you do come back, again, we do need you to type in your name, email address, license number, one more time. One question before we go, John. How are trusts treated? Would it depend on the type of trust?
That's a good question. And the answer is it completely depends on the type of trust, whether it's a revocable trust or an irrevocable trust. In a general sense, any entity that owns real property, any individual, be it yourself, or if you've got a partner, a co-owner, or an entity, be it a partnership, LLC, corporation, sub S corp, or if the property is owned in a trust or even in an estate. If the entity that owns the property owns it and it has a gain sitting inside the property, that entity can do a 1031 exchange. So a trust could do a 1031, sell a property, do a 1031, buy a replacement property, and it would go back into the trust. When you start getting into how the trust's tax treatment is handled, then it's really heavily dependent on what kind of trust it is and how it all operates. And those trust documents can be extremely complex. So the short answer is a trust can do a 1031 exchange, but how a trust operates will depend on what kind of trust it is. All right, Dana, thank you.
Yes, sir. I'm going to reclaim the host from you, John.
Okay.
All right, everybody. Let's take a 15-minute break and we will be back. John, this class makes me want to go back into real estate and go find some people to help out.
Thank you, Dana. I appreciate the opportunity to be with you all today.
All right, everybody come back in a quarter till. John, again, this is just amazing, amazing information. Makes me want to go back into sales and actually interact with the public. Just so many opportunities and different ways to mix and match properties with the tax, to help with their taxes. And sometimes you can have, I remember when I was selling, there was one year when the economy was just fantastic. And, as a real estate agent, you always think, gosh, I want to help my client make money. Well, I had a lot of clients that wanted to take a loss on their real estate holdings, their investments specifically, because they needed to offset their income in other areas of their life, and they needed to show a loss. So this is just a much better way or different way or just a way to help somebody save tens of thousands of dollars on their taxes. And what an amazing value you bring to the relationship, you guys, as an asset to help people think about real estate in a different way. And just becoming an expert in this, it just opens up your minds, should be just going, and just a whole nother set of clientele or way to market yourself should totally be your mind, the gears in your mind should be turning. Andrew, sorry, I can't resend the questionnaire. Once it's up there, it's up there. It might be minimized on your screen. But I don't see any questions, John, so I am going to make you the host again and let you continue on. So make host. There you go. All right, back to you, sir.
Thank you, Dana, and thank you again for letting me join your group this morning. I'm just going to say it's tricky doing a Zoom presentation. I appreciate everybody's engagement and involvement and taking the time to type the questions. It's almost as good as live, but it's helpful. Dana, one question that I caught before everybody was signing back in.
Okay.
As the intermediary, does Starker pair up people who are doing exchanges? That question is going to be answered. I'm getting ready to diagram a transaction. We don't pair anybody. Typically, our work is done directly for the client who is the seller of the real estate. A lot of y'all, if you find yourself in a 1031 situation, at some point, I'll need to talk to your client because that's the person that we are serving the intermediary role for. But I'll be diagramming that, so hopefully that'll become a little more clear in just
John,
a minute.
I've got a couple of questions that you may address, but just as a broker, seeing a lot of the contracts that we're seeing, especially with somebody buying one, selling another with this exchange, are there provisions for delays? Number one. Number two, what happens if the deal falls out? For example, a buyer terminates, a seller terminates, whether it be by an agreed upon contingency or by default. And just the regular headache type issues that do occur with regular real estate transactions, regardless of the tax benefits of handling it as a 1031 exchange.
So Dana, as a broker and the other brokers that run the Maximum One offices, you get all kinds of questions. But let's split this into both sides. If you're selling a property and the seller has a gain and the sellers talk to us about doing a 1031, generally, we don't get formally engaged until you're past the due diligence period. So if a seller is selling a property and the buyer comes along, wants 10 days due diligence and drops out during those 10 days, really not a big deal because the property hasn't sold yet. If the buyer drops out from due diligence to closing, you've probably got an earnest money question. Who gets the earnest money? But again, not a 1031 question because there hasn't been a transfer. There hasn't been a sale, a closed sale yet. Where you run into the scenario that 1031 gets impacted is after the 1031 has started. We've sold a rental property, let's call it a rental house. We've sold a rental house and the client is now in the time period, the 45 and 180 days. If the client writes a contract on a replacement property and fully intends to buy it, this is where a real problem could arise. And without even getting into the 45-day issue, what if the client, the guy who's selling the property, your client, the 1031 exchange client, sells a property, puts a new one under contract, and plans to close on it in 30 days. And the seller of the replacement property, the seller of the new property, just refuses to go to closing. So as a broker, you don't want to have to invoke this, but you've got the ability to invoke specific performance. And if the seller of the replacement property won't go to closing or tries to terminate, and you've got a legally binding agreement, what happens is the damages, if the seller fails to sell, the damages can be potentially increased by the amount of the tax liability that your client, the exchanger, was going to have to pay. And I've been involved in a transaction where specific performance was invoked. Nobody had to go to court. The seller wound up coming to closing, because once he says, wait a minute, I've got to defend myself in a specific performance suit, and there's potential tax liability that I could be assessed for, it gets very messy. I don't see that happen very often. In today's environment, where you might see it creep in would be the seller of the replacement property who is selling a replacement, and your client, the exchange client, has a good deal. Let's say it's a really good deal, and the seller wakes up and has an offer come in, and he can sell it for more money. And he says, I don't want to sell it to Dana's client. I want to sell it to the next person because I want the more money. That's the reason we have written contracts. It's a binding agreement. It's enforceable. And the additional penalties because of the tax liability, if he doesn't complete his exchange within 180 days, I see every reason why a judge would support adding that to the damages.
So just a couple of comments and then one question on that. You guys, I have a separate YouTube channel called Real Estate Made Crystal Clear, where it is my target audience are all real estate agents in the entire state of Georgia. It's contract issues. It is license law issues. It's all these kinds of issues. And I have done a video on suing for specific performance. My understanding right now, the Georgia courts are 2 years behind in hearing those cases. Those are 2 years out. However, your clients would definitely need to hire an attorney. There are certain steps that a buyer may take that would tie up the title to the property, at the very least, not to resolve the specific performance lawsuit, but perhaps to buy time to negotiate through those issues. So please, your client, if a seller does terminate by default, your client absolutely needs an attorney immediately in order to tie up that property to try and work this out. And then, John, my broker question is, does if a public person is buying as part of a 1031 exchange, does that need to be disclosed in the contract? And the reason I raise that is the GAR contract and now the RE forms contract specifically state that the penalty for default, for a seller default, is either termination, getting the earnest money back, or specific performance. It does not invoke damages. Now, you guys, a buyer and a seller can sue anybody for anybody, but what they agree to as the remedy for default is in the contract. So my question is, number one, does this need to be disclosed? And number two, if it is disclosed, that might help out with their lawyer staking a claim for additional damages, even though the GAR and the RE forms don't specifically say that the buyer could sue for that.
So, Dana, we could go a long way down the rabbit hole of what the GAR contracts do and don't do. We're now up to about 11 pages on a standard contract. Because the GAR contract is silent on damages, I don't think that you're precluded or that you will win them automatically. If you have to go to court, the judge will rule. And when you go to court, all bets are off. The judges will do all kinds of things. But the first question is, when you're writing a real estate contract and it's part of a 1031 exchange, what do you need to put in there? Again, I'm going to diagram the transaction, but let's talk about it for a minute first. When you're selling the relinquished property, when you're selling the first one, you're going to want to include either a special stipulation or there's a GAR form, a specific GAR form that references 1031 exchange. And the message is, it's the intent of the seller to perform a 1031 exchange. The buyer agrees to cooperate by acknowledging an assignment at no additional cost or liability to the buyer. And what that does is position the contract and the seller to allow the intermediary, and again, we'll diagram this, but it allows the intermediary to step in the shoes of the seller to structure this as a 1031. It doesn't create any hardship or cost or potential liability for the buyer, but you've got to notify the other party of your intent to do it. And I believe if you put it in the first contract, well, generally you don't see problems on that end. But If you have it in the contract, you're in a stronger position should you get engaged in a lawsuit. On the replacement side, when you go to buy the replacement, if you're the 1031 exchange client, you put the 1031 language in there again, and you say it's the buyer's intent to complete a 1031 exchange. The way that I spin that to a positive advantage for y'all who are working with clients and for the sellers, and Dana, as you're coaching folks in your company, if you put 1031 language in the contract and the seller of the replacement property sees that and says, what is that? I always say, I've already started a 1031 exchange. I'm doing a 1031 exchange, and I've already got a pot of money, which I can provide a proof of funds or a verification of deposit. Therefore, I am a stronger buyer than a buyer who has to come along and get 90 or 95 or even 80% financing. In other words, the fact that I'm doing 1031 means in a lot of cases, there's a good chunk of cash to be used to buy the replacement. So when applicable, you want to promote that and say, that makes me a stronger, better buyer. And if it'll help you win a deal in today's market, not only have you covered your backside by putting it in the contract, but you potentially have a bargaining chip that makes you a stronger candidate.
Fabulous. One more question, and then, and those are special stipulations. And if you guys give me 1 second, I will type those in the chat where you can find those GAR written out special stipulations. One more question, and then you guys, I'm afraid we're going to run out of time, so we need to let John continue on. When an entity owns multiple properties in multiple states, are the taxable gains over, say, $500,000 based on the primary residence location, or where the transactions are based out of?
So when we talk about an entity owning multiple properties, if an entity owns properties, we're generally not talking about a primary residence. We're probably talking about investment properties. And if that entity sells those properties, sells one or many, the federal tax rate is still going to be a maximum of 20% if they're capital gains qualifiable properties. If they're in states with no income tax, Texas, Tennessee, Florida, some others, there may not be a state level tax. But the $500,000 exclusion on primary residence only and strictly applies to the property that the taxpayer owns as a primary residence. And generally, you don't see entities owning primary residences because the exclusion is an individual exclusion, not an entity exclusion. So you've got to look at what's being sold, what state it's in. It'll get hit with federal tax everywhere, and it'll, unless you do a 1031, and it'll get hit with state tax in those states where it's state specific. Okay, let's go back to the material. Dana's right, and I want to be sure we've got time for questions as we move through the next couple of spots. Let me see if I can go back and share. Whoops. And current slide.
There we go. Okay. We got it.
All right, good. So we talked about like kind, multiple properties, fractional interest. We talked about vacation property. What I'd like to do now, I'm going to use the characters on this slide to diagram a transaction. We're going to list and sell a property. We're going to put the funds in escrow, and then we're going to go down the road and write a contract and buy a replacement. And then we'll link these transactions together as a sequence of two closings to make the exchange complete. At this point, just a quick refresh, if you will. We talked about the four essential elements of a 1031 exchange. Number one, tax savings. And we set up a scenario where there was a potential $41,000 tax liability on the sale of a $250,000 rental house. That's the transaction we're going to talk about on this slide. Property A up here at the top of the slide is that rental house owned by Mr. Smith. So what's a 1031? Tax savings, investment property, and we're going to roll in time period as we work through our exchange sequence. So on a step-by-step basis, we put the property A on the market, and we'll write the contract between Smith and Jones. In that contract, there will be a stipulation that references that it's part of a 1031 exchange. We just talked about that a minute ago. And whether you use a stipulation or the GAR form really doesn't matter. If it's in there, that's going to get everybody on notice, including the closing attorney. Now, one point in terms of timing, because we're going to talk about the timing, the 45 and 180 days, and we'll use today as the starting timeline, August 19th, when we get down to the diagram. But think about what happens before you sell the property. You listed this house in today's market. You may have just listed it yesterday or a couple of weeks ago, but you probably talked to your client, Mr. Smith, a couple of months ago. And you may have said to Mr. Smith, we can help you list and sell your rental property. It looks like it's worth something on the order of $250,000. When you're ready, we'll put it on the market and we hopefully will find a buyer quickly. But your conversation with Mr. Smith might have started back in June or July. And when you had that conversation, remember, you're talking about an investment property. You probably will have suggested to Mr. Smith that it could be part of a 1031 exchange. And you can pass along material that you've gotten from this course. You can tell him the quick high spots. It's saving taxes on investment property. But the important thing you want to tell Mr. Smith when you are talking to him about listing his property is that the critical time period is from the day of closing, which if the day of closing, again, is going to be August 19th, the critical time period of 45 days to identify replacement property starts on the day he sells the house, in this case to Mr. Jones. We've got Mr. Jones over there on the left. So you should have Mr. Smith thinking about a 1031 2 or 3 months ago and potentially talking to his CPA so he understands the tax consequences. That's some of the best work you can do, even though it's just mentioning the questions that Mr. Smith needs to ask of his other advisors, because that gets Mr. Smith looking down the road at what is suitable replacement property. You've heard the adage, I think this comes from Stephen Covey, start with the end in mind. And the end is, what is a suitable replacement property? If I'm selling property A, what is it that I might want to buy or own as a replacement property? Whether it's another rental house in Atlanta, whether it's land, whether it's, whatever it may be. So the sooner you have Mr. Smith thinking about that, the longer the lead time, the better, because all the days before closing don't matter. He could start looking a year ago. He could start looking 4 months ago. Obviously, what's out there 4 months ago won't be out there today, but he will have a sense of what the market's all about. So you listed the property a few weeks ago. A buyer comes along. You're now under contract. Smith is going to be selling property A to Jones. What's going to happen at closing, and if you see the A here in the middle, the 1031 stipulation will allow Mr. Smith to assign the contract to an independent third party, a qualified intermediary, who will step in Smith's shoes and then follow along the bottom. We're going to sell property A to Mr. Jones, and the money from the closing will go into an escrow account. In our company, we use a dual signature qualified escrow account. The signatures will include Mr. Smith's plus the intermediary, Starker in this case. And so the funds are not going into Mr. Smith's hands. He will not trigger a sale. He will not trigger taxability at this point. And the other thing that happens at closing, actually, there are two very important things. One thing is the deed goes directly. If you follow the deed flashing there on the computer, the deed is in Smith's name this morning, and this afternoon it goes into Jones's name. The deed does not have to pass through the intermediary. We can allow, the regulations provide for a direct deeding sequence. But the other thing that happens at a closing, and those of y'all that raised your hands when we were talking about who's been involved in a 1031, is commissions get paid. This unfolds just like a regular closing. The difference will be the intermediary is posted on the settlement statement. The funds go to the intermediary on behalf of Mr. Smith. Now, if the transaction closes today, August 19th, the clock starts running. And what I've done here, you see the timeline across the bottom? You've got 45 days following the closing to identify replacement property. And we'll talk about that. You've got a total of 180 days to get from one end to the other. In other words, from the day Jones buys until the day Mr. Smith, you can see where he's going to go. He's going to buy from Miss Brown over here on the other side. You've got 180 days to get there. If you want to think about it in two pieces, it's 45 plus an additional 135. I will tell you, in today's environment, if you identify property by the 45th day and you just put an address or multiple addresses on a written target ID letter, that's not necessarily going to be enough. If you don't have a sense that you will be able to control and purchase the replacement property, which means get that thing under contract, there's so much competition in today's market that Mr. Smith could identify 2 or 3 properties, but cash buyers or other buyers could come along and pay more. And Mr. Smith will be out of luck if he's trying to write a contract on a replacement property that he listed on the 45th day, and he's trying to write a contract on the 50th day. My strong suggestion, if there's any soapbox I will stand on at length, is to tell y'all, the representatives of Mr. Smith, remember, you're the seller's agent when he sells the property A, you're going to be the buyer's agent when he goes to buy property B. Encourage him to make offers, encourage him to go shopping, and encourage him to find and buy, or excuse me, contract for replacement property, so he doesn't get caught up during that 45-day period. It has never been as critical as it has been in the last 3 to 6 months with all this competition of price run up and prices, offers going over asking. It's critical that Mr. Smith get control of the replacement property that would be good for him. So back to the timeline. On or before the 45th day, you've got to identify uniquely in writing, which generally means a street address, city, state, zip code. It includes a unit number. If it's a condominium, you've got to specify the unit. It's got to uniquely identify the replacement property. And in his case, let's go look at his transaction. He's identified property B. And so on property B, we're going to write a contract. Y'all are going to write the contract. And it's going to say, Miss Brown, I will pay you for property B. This is part of a 1031 exchange. Again, you're putting it in the stipulations, or you can use a separate amendment if you care to. I think 99% of the contracts that we see in process, people just include it as a stipulation. So we sold property A to Jones. The funds went into escrow. Remember, we sold a little rental house for $250. We're going to go buy Miss Brown's replacement property. There's the contract. And at the closing, let's say the closing happens fairly quickly. Let's say it's going to happen at the end of August, because they can happen. They don't have to go 30, 40, or 50 days. But if the closing happens at the end of August, the funds go out of the exchange escrow account. Starker will wire the funds to the replacement property closing. Miss Brown will transfer the rights and interests in property B through another contract assignment through the intermediary, who transfers it back up to Smith, and the deed goes directly, here's our deed again, the deed goes directly from Miss Brown to Mr. Smith. So if you look at this diagram, the yellow arrows on the left are the relinquished property. That's where Smith is selling or relinquishing property A to Mr. Jones. And the blue arrows on the right are where he's acquiring the replacement property from Miss Brown. The way this has happened is 2 separate and distinct closings, 2 totally unrelated people, Mr. Jones, Miss Brown. The qualified intermediary in the middle actually creates the link from one property to the other. There are 2 sets of documentation that go into place each at one of the closings. And if Smith should be audited, he's got documentation from the sale, documentation from the purchase. He's got a target ID letter. And when you put all that package together, you check off everything that the IRS would ask to see to make that 1031 exchange a valid 1031 exchange. So in the world of the intermediary, if you look down at the bottom, that's the role that my company serves. We didn't find Smith and Jones. Y'all found Smith because he wanted to list and sell the property. And this goes to the question of, does the intermediary match any people? We don't match people. We don't get in the middle of the real estate transactions. The intermediary handles the transaction between Smith and Jones with documentation, and the transaction between Smith and Brown. Smith is actually our client for purposes of the 1031 exchange. Jones came to you through probably an outside third-party real estate agent, and Miss Brown probably came to you from an outside third-party real estate agent. You found her house in MLS, FMLS, wherever you found it. So at the end of the day, the way we refer to this process, we've got phase one on the left and phase two on the right. And the exchange is simply a sequence of two separate and distinct sales transactions. So I want to pause here for a second because I just threw two closings at y'all, step by step, and everybody raised their hand and said, sure, I've been to a closing. That's all we wanted you to do was go to two closings, but you've got to manage the time frames. You've got to watch the 45 days. You've got to watch where Mr. Smith is in the sequence if you are working with him on both transactions. Sometimes Mr. Smith is going to move his property or his exchange and his funds from one place to another, let's say Atlanta down to Florida, and you may not be in that transaction, but you want to help Mr. Smith keep his eye on the timeline, make sure he has a good understanding, and be, the professionals that you guys can be. All right, let me look at a couple of questions. Can any closing attorney serve as a mediator? Some attorneys provide 1031 services. Many do not. They specifically do not want to be involved in that element of the process. So you would have to ask if the attorney does that. Some title companies offer 1031 services. And of course, yours truly, we're obviously in that business. Some attorneys are precluded from offering 1031 services. If they are the attorney for the seller, if they provide other legal services, they would be a disqualified party. And then a question on the 1031 funds. Can the 1031 funds, let's see, let me just read this. Could you go into those 1031 funds in relation to appraisal requirements as opposed to it being treated like cash? Sounds like you couldn't win a multiple offer with a 1031 buyer willing to go over appraisal value with said funds. If you're doing a 1031, if your client's doing a 1031 exchange and he's coming out of a property for $250,000, let's just say he's got all cash. So he's got the strength of $250,000 in the exchange escrow account. You've got to look at what the replacement property is going to be. Let's say it's $400,000 and he's got to get a mortgage for the remaining $150,000. He's still going to be in a position where an all cash buyer could be perceived as stronger because your client is going to use some cash and some mortgage. And if he goes over the 400 asking price to win the deal, let's say he goes 10% over to 440, the property may or may not appraise. However, he would have to get a mortgage for 190. And the question I would put to you and to your client and ultimately to his lender, if he brings 250 cash to the table, will a lender lend 190 on a 440 price, even if it appraises only for 400, the asking price? Many lenders will say yes to that question because they will lend, that's still less than 50% loan to value. It gets into some of the criteria that, that the lenders have. And so y'all's job as the agent for the seller or as the agent then for the buyer of the replacement property, you're always having multiple conversations. You're talking to the closing attorney, you're talking to a lender potentially, helping to coordinate all of these facets. And the question on the loan is going to obviously relate to what the lender policy will be. Question on what are the fees in the transaction? You would find if you polled 1031 exchange companies, you're going to find fees that are generally $1,000 or less. Our fee for a 1031 is $750, not a big number. The bank charges $100 for the dual signature qualified escrow account. So in terms of talking to your client about what's a 1031 going to cost, if you tell them that generally you can expect to spend $1,000 or less, then you're going to be in the right range. Some intermediaries will charge more, and it'll be up to your client to choose who they want to use. And then, of course, the question, do agents get a referral fee? We don't do that. We also don't ask for referral fees from the commission side that y'all get. One point I like to make, if an agent brings us a 1031 client and you're helping them sell the relinquished property, if the 1031 client asks us who they should use to buy replacement property, there's only one answer I give them, and that is you go back to the agent that you're working with on the sale. Never, ever, ever do I send a 1031 client to a different agent. So I don't have any crossover. Let's see, question, try to contact the person conducting the exchange for proper wording that they would like included, so there are no updates needed later. Jeff, that's a good question. If you know your client's doing a 1031 exchange and you want to get the proper wording in there, there's the GAR amendment. You can pull the language from that and include it as a stipulation. We're happy to give you the wording we use. There's some wording in the brochure that Dana has sent out to everybody. It doesn't have to be completely magic. It has to reference 1031 exchange. Most attorneys have seen plenty of 1031 exchange transactions. If somebody would like the wording that we suggest, I'll be glad to send it to them. Shoot me an email. But I do like the idea of a good tight contract from day one, where you get the 1031 exchange wording in there from the beginning. I think that's smart.
And the GAR, it's not an amendment, John, but GAR has the 1031 exchange as a special stipulation. It's special stipulation 506, which is exchange buyer utilizing section 1031, and GAR special stipulation 508, exchange seller utilizing section 1031.
Terrific, Dana. I worked with the Forms Committee. There, once upon a time, it was a separate amendment, but it's just a sentence or two, and I like that it's been reduced. That's great. If somebody's buying a smaller property, let me hold that question. I'm going to address that when we talk about balancing the exchange, which is what we're going to do coming up in a couple of minutes. And could you exchange 3 times the property value to qualify for 1031? That's also going to be a balancing question. But in reference to that, and when we talk about the transaction, let's go back and let me see if I can get the shared screen back up again. One of the things that you want to keep in mind, if you look at the exchange sequence, phase 1 is where you're selling a relinquished property. Phase 2 is where you're acquiring a replacement property. And I'm trying to not use the words buy and sell, because there's a purchase and sale going on depending on which party you're referring to on both sides. But when you put the hat on the exchange client, he's relinquishing in phase 1 and he's replacing in phase 2. So in phase 1, he could relinquish multiple properties, whether he sold 3 rental houses to Mr. Jones. Mr. Jones could be a hedge fund. He could sell 50 rental houses. He could relinquish multiple properties. And then on the replacement property side, on phase 2, he could acquire, excuse me, he could acquire 1 or multiple properties. And again, on either side, there could be 1 or many or fractional interest. And if it's multiple properties, then it becomes math. For example, if he were selling 3 houses to Mr. Jones, 3 rental houses at $250 a piece, that would be $750. On the replacement property side, if he buys 1 from Brown for $400, that's not enough. He's not gone to equal or greater value, not yet. But if he bought 2 from Miss Brown, $400 a piece, that's $800. So selling for $750, buying for $800, the math works all day, no problem there. Let me see if I can jump back, because I wanted to catch a couple of these questions. Once the first property is sold, is there a way to change intermediaries? Some companies will accept an assignment of intermediary. We don't. If somebody has started with another intermediary, we don't start in the middle. We want to be involved in the beginning, or we'll just politely decline to participate. And then does the intermediary, or do we serve as the closing attorney also? We don't do tax or legal work. And I know we're talking about a section of the tax code, and I know we're talking about taxes, and it may sound like I'm giving tax information, but we don't give tax advice to the client, and we don't do the legal work associated with closing. We don't do title work, we don't do closings. We prefer to be independent and work strictly in the world of the intermediary. And is there a time limit for how many replacement properties you can buy? Back to the slide, if you look at the bottom, remember the 0 day would be today, the day of closing, 45 days to identify, 180 days to acquire the replacement. And one thing about the 180, there's a total of 180 days to get from one end to the other. It's not 6 months. There was actually a court case where a taxpayer went to court because he sold a property in the middle of June and he bought the property in the middle of December, June 15th, December 15th. That's 6 months. What's wrong with that? July, August, October all have 31 days. He was 183 days. And the judge said, there's nothing ambiguous about 180. The transaction fails, and his exchange was overturned. So I reference 180, 180, and 180. And some people will say, well, we've got 6 months. If you were to really push it to the end, it could be problematic. So better to just remember 45 and 180. Every document that we send out that references a time period says 180. We don't ever say 6 months. Limit to how many replacement properties you can buy. There's not a theoretical limit. If I were to sell, let's say, a $10 million piece of land, and I wanted to go out and buy $100,000 rental houses, I could buy 100 of them. However, managing the logistics of lots of transactions becomes really pretty cumbersome. And of course, if a property is not available to be purchased, you can't go force a seller or an owner to sell you the property. So while there's not a theoretical limit, the limit that's on a practical level more important is what you identify within the 45 days. During the first 45 days, there are a couple of rules, and I'll be glad to send this flyer across. The first rule says you can identify up to 3 properties of any value. I will tell you from our perspective, a practical anecdote, probably 90% of all of our clients buy 1 replacement property. In today's environment, it's hard enough to find 1 good deal versus finding multiple good deals. So people will list 1, 2, or 3 properties, and 95, 98% of all clients are just listing a short list. They're looking at them hard, they're doing due diligence, they're getting them under contract before the 45th day, and they're securing their position and their tax savings by being able to close on it shortly after. One more note, our industry, the world of 1031 intermediaries, did a study. It's been a couple of years now, but the average life cycle, the average duration of a 1031 exchange was 62 days. So very few people get out to 180 days. That's the exception rather than the rule. So most people get their job done, they find the replacement, they get it under contract. And I'll tell you, a really well executed exchange, I don't have the ability to draw on the slides, but if I could back up the timeline, if August 19th today is the 0 day, I've got plenty of clients who start shopping for replacement property and put it under contract before they have sold the relinquished property. So it's possible that Mr. Smith had a contract to buy the replacement. See, jump right back to it. Mr. Smith had the ability to buy the replacement. If you look at the 0 day here on the far left, August 19th, he could have been under contract on August 1st. So he sells property A on August 19th, and he buys property B August 31st, in and out in, whatever that is, a couple of weeks. That's a really well executed exchange. That way you don't run into timeframes, you don't run into an inability to find replacement property. Everybody's happy. And you, the real estate agent, hopefully will have helped Mr. Smith with both transactions. And obviously what that means in terms of how many transactions you close in a year and ultimately your paycheck. Okay, I want to move forward because this is going to fold into the exchange sequence. Again, what's a 1031? Tax savings, investment property, time period. We're looking at the time period, 45 and 180 days. It's a sequence of 2 transactions. The last element is equal or greater value. And I want to work through that, and then I want to go back and respond to questions. So if anybody's ever solved all the world's all the world's problems on the back of a napkin, you'll chuckle at this, but it's just about this easy to analyze the math on a 1031. So the property we're selling is $250. That's the same rental house we've been talking about since earlier in the program. The replacement property is $400. And right now, we're just going to talk about selling one and buying one. When we go to closing, the proceeds from the relinquished property go into the exchange escrow account. But at the closing, if there was a mortgage, look at this bottom line, if there was a mortgage on the sale side, on the property being sold, that mortgage gets paid off, just like a regular closing. And so the equity in the transaction, the cash, is what actually goes into the exchange escrow account. And when you look across the slide on the property you're purchasing, on the replacement property, if you're putting 150,000 of equity into the deal, hopefully that will put you in a strong negotiating position because you're the 1031 exchange buyer and you're putting a whole lot more than 5 or 10% down. But obviously you still have to get a mortgage for the difference. In this case, it's 250. As long as you are equal or greater in the sales price, which is 250 to 500, and you spend the cash, jump forward, equal or greater in the sales price, and you spend the cash going forward, you'll be totally tax deferred. You'll be 100% tax deferred. And if y'all remember, the calculation on the tax liability on this transaction was looking like something on the order of $41,000. So this is a win. We sold for 250, we bought for 400, we put 150 in, and I will tell you from talking to many, many lenders, you put $150,000 down on a rental, a replacement property, getting a mortgage for 250 is easy to do, easy to do. Now, let's look at a situation where you've got boot. Boot is something in a transaction that is unlike property. So follow across the top line with me. The property being sold, again, is 250,000, and the replacement property is 300. So on the top line, you say, hey, that's equal or greater value. But the equity that comes out, remember there was a mortgage of 100,000 that got paid off on the relinquished property. The equity of 150 that comes out, when you only put 100,000 into the replacement, then you go get a mortgage for 200. It might be that you're planning to put the other 50,000 on another property. It might be that you're planning to take the cash out. But what happens here is, if you take the cash out, they call it boot, colloquial term, the cash boot is taxable. And when the cash comes back to the exchange client, he'll pay tax on the 50,000. It's not considered part of his original basis. The IRS deems the boot to be the profit layer. So cash boot, whatever the amount is, 10,000, 25, 50, the cash boot that comes out would be taxable. So back, let's see if I can do this. If I can get back to my diagram. Once again, the exchange sequence. We're selling to Mr. Jones for 250,000. The proceeds from the closing, 150,000, goes into the qualified intermediary's dual signature qualified escrow account. And then the 150 goes into the acquisition of the replacement property, which is Miss Brown's house that is purchased for $400,000. And you have helped Mr. Smith defer the payment of $41,000 in combined federal and state capital gains tax. Okay, let's see if I can address a couple of questions, because once I start throwing math in here, it makes your head spin again, or sometimes. Let's see. Is there a limit for how many? Oh, we talked about that one. For those doing a lot of stuff in the background, oops, your camera can be off. Whoops. Does your business as an intermediary mirror the tempo of the real estate market in general? Yes, it does. We had, as an intermediary, remember, 1/3 of the market is non-owner occupied houses, 1/3 of the residential market. We had one of our biggest months since 2008, I think, in the last couple of months, because we saw a huge increase in 1031 exchange transactions. And even though, here's again a little anecdotal information, even though our clients are selling property and it's a high market and they're reluctant to come back in because their replacement property is also going to be high, the concept of a 1031 exchange is based on the idea of a continuity of ownership interest in real estate. So people can sell one property, get rid of one property, and acquire a different property, different part of town, different kind of property, but they don't lose anything to taxes. And even if they're paying today's higher price for what they're buying, some of them are going to say, oh yeah, I could have bought this last year for $40,000 less. Well, that may be the case, but the one they sold also would have been sold for a lower price if they'd sold it last year. So 1031 happens in a short period of time, a few months, up to 180 days. And you're keeping your funds at work in the existing market. So if you believe in the real estate market, generally people are going to say, I can find something that will work for me because I want to keep my dollars at work. And more importantly, I really want to keep the IRS's money working on my side, not on the IRS's side. Okay. Let's see. Since proceeds from the first sale have to go to the intermediary, is it a good idea to allow a few banking days? That's a great question. Again, thinking about our timeline, we're selling a property on August 19th, and let's say you want to buy the replacement property on August 20th. I had this happen once. Guy was selling a property, his closing was in Marietta. He wanted to buy a replacement property down in Savannah. And I said, how are you going to get the money from Marietta to Savannah in the same day? Well, when the closing happens, I'll just have them wire the money. Have y'all ever had an experience where a closing attorney didn't wire the money the same day? They wired the money the next day? That happens. And he said, well, I'll just take the check. Well, y'all remember, you can't take checks to closing anymore if it's over $5,000. It's a good suggestion if you've got both transactions, the relinquished property and the replacement property. If you've got both transactions lined up to close fairly close together, put a week or 10 days or 2 weeks between them. The practical aspect of that is that closings get delayed. And I know y'all have seen this. You've experienced it. We've experienced it constantly. If the first property gets delayed, if somebody invokes the 8-day unilateral extension and your first closing gets delayed, then you've got to go through all the gymnastics to extend the second closing. And so I've always found that it's good to put 10 days, 2 weeks between the two closings. It gives everybody some breathing room. It lets the closing attorney process the paperwork, funds get received, and then there's plenty of time for the funds to be wired to the replacement property transaction. So a few banking days is prudent. 10 days, 2 weeks is even conservative. Question, calculating the taxes on the cash boot, is it still 20% federal, 6% state, and 25% of depreciation? The taxes on the boot will be calculated based on whether the property had depreciation or not. In other words, if it was a rental house and it was improved property, the taxes on the boot will kick in first at the depreciation recapture rate of 25% federal plus 6% state. If the property being sold is land, then it kicks in at the maximum rate of 20% federal, again, subject to the taxpayer's other income items. So it could be lower, like 15%. So the boot calculation is a little nebulous, and it'll depend on what else is going on in the client's tax return for the year in which the boot is received. And then question, can funds invested in a syndication qualify in a tax exchange situation? If you've got funds in a syndication or in a partnership, again, any entity can do a 1031 exchange, and the entity that's selling a property could exchange, but the same entity would have to buy replacement property. Topic for a different conversation, and I can send you some information on partnerships. If there are several people who own property together, but it's in an LLC or a partnership, and that group of people want to go different directions, potentially the property can be distributed from the partnership, and each person can choose to do their own exchange or not. But property held in a partnership or a syndication, you'll want to talk to whoever the managing partner of the syndication is as to whether the viability of 1031 exchange works. That gets into a lot of complexities, and I always suggest get the attorney involved, get the CPA involved. That's going to go well beyond what a typical real estate agent is doing with real estate contracts. Okay. All right, let's jump back to the material. Y'all are doing great. Y'all are doing great. Okay, we talked about the napkin test, equal or greater value. So the four elements, tax savings. Remember, we're looking at a maximum of 20% federal, 6% state, variable by state, 25% on depreciation recapture. So we got, what's a 1031? Tax savings, investment property, which was the whole like kind slide. All kinds of property will qualify. Tax savings, investment property, time period, 45 and 180, and equal or greater value. And the equal or greater is really pretty straightforward. One thing I want to point out, and it's not on this slide, I don't like to put too much detail on most of these slides, but if you're selling a property for 250, the net selling price might actually be, let's say the number's 235. When you're selling a property for 250, the costs of sale, like the commission and transfer taxes and costs that the seller, the exchange client would pay, can reduce what your target number is, what your required number is. Usually commission is going to be one of the bigger numbers. So the commission subtracted from 250 and some other sales costs might get your client down to 235. For purposes of getting the concepts out, I just work in the top line numbers, but sometimes it will make a difference because there's a few dollars going one way or the other. Another thing, another concept when we're talking about the napkin test, and let's just use 250 as our top line number for our conversation. If your client is selling a property for 250, and we know that to be totally tax deferred, it's got to be equal or greater value. A strategy for y'all as real estate agents, if you go to MLS and say, show me everything in a particular zip code that's 250 or greater, so I can help my client find replacement property, you might miss an opportunity that's priced slightly below the threshold. What would happen, and we did this on the cash boot side, in this case, they went greater value, but took cash out. But what would happen, I just want to turn this off for a minute. What would happen if your client bought something for 225 and their relinquished property, see if we can jump back, their relinquished property is 250. Imagine the right side of the slide says 225, but it's a killer deal. And y'all know what a killer deal is. It's the one when you're driving down the street, you point at the house and say, that's a killer deal. Somebody ought to snap that up. Well, don't not look at the killer deal, even though it's below the threshold. If your client were to sell for 250 and buy for 225, he or she would pay tax on the differential, which in this example would be 25. But if the 225 property, if you win that deal, if you get that under contract and it's a killer deal, it may be well worth paying the taxes on the differential versus overpaying for a property that's not as good. So I always suggest in a conversation with your client, look a little below the threshold, whether that's starting at 200 and going up or 225 or whatever feels good. Again, this is an art, not a science, but looking a little below the threshold, creating a little bit of taxability, still gets your client most of the benefits. Plus, if you find the killer deal, if you find the really good property, then you've done a tremendous job for your client. Okay, enough on balancing the exchange and creating boot. Let's talk about a little case study. I want to bring a case study into play, and then I'm going to go back and respond to some questions. This case study identifies different kinds of property, multiple ownership, different kinds of replacement property. It solves a situation that is not every transaction, but it summarizes a number of concepts. So imagine that you've got a property, there's a farm here, there's a house where the farmer lives, there's a barn and cows and a field with crops, and the farmer's going to sell this piece of property for $2.5 million. He's lived there all his life, he inherited it from his father, he's got an extremely low basis. And because he lives there, if you carve out the property where the house is located, he's got 5 acres and a house. We didn't go as far as putting in the driveway and the swimming pool, but imagine that they are there. Developer comes along and developer wants to buy the 100-acre parcel. It's a total 100-acre property. The farmer says, well, if I sell my house, I can exclude $250,000, but it's all one parcel. Can I do a 1031 exchange also? And the answer is yes. You can do a 1031 exchange on the property held for investment, excuse me, or in this case, the farm property. You got to allocate the price. And I would say that's not the job of a real estate agent. That's the job potentially for the appraiser or for a CPA or somebody who can provide the service to the farmer. You might be able to give a broker price opinion. You might say houses in the area that sit on 5 acres sell for $250,000. However he arrives at the house price, let's say the rest of the money gets put on the farm. In this case, $2,250,000. And if you look at the code sections out here to the far right of the slide, the farm is being sold and you can do a 1031 exchange. The home, which gets covered under section 121 of the tax code, that's where the home can exclude gain up to $250,000. So if the house is worth $250,000 and you exclude the whole sales price, the farmer can go to closing, put $250,000 in his pocket and do a 1031 exchange on the remaining $2,250,000. Once the 1031 exchange starts, the farmer goes out in the market and starts looking for replacement property. But here's an interesting thing I've seen, and 30 plus years ago, when I got in this business, I wouldn't have told you that I would see this coming. I've had a lot of conversations with exchange clients that, because they're investors that are in the game for the long haul, they're going to be there for a long time. And the farmer sat down with his family and said, I don't want to be dealing with real estate forever, but I'd be willing to do a 1031 and buy property that might benefit the next generation. In other words, you look at a sale as a transaction. You look at a 1031 exchange as a process of 2 transactions. But if you look at your relationship with your clients and the potential for a long-term relationship with an investor who's going to exchange periodically, now go one step further and look at the potential for a relationship with more than one generation. In this case, the farmer sat down with his 3 kids and agreed to buy the following 3 properties. Number 1, an office building. One of his sons is a CPA, and the CPA said, I'd love to set up my practice in my own office building. Dad, if you'll buy the office building as part of the 1031 exchange, I will pay you rent. And so the farmer took a third of his $2,250,000 and bought an office building for $750,000, set the CPA up in the building. Who do you think is going to get that building when the farmer passes away? The next property was a piece of land. The next son said, Dad, I'm going to do what you did. I'm going to buy some land, have some crops, have some livestock. And so the farmer went to an area further out and bought a big piece of land and leased the land to his son to run a farm. The last parcel was a fractional interest in a veterinary clinic. His daughter was the veterinarian, and the daughter and her husband were opening a veterinary clinic. So the farmer bought the building and leased it to the veterinary clinic. The farmer bought half and the husband bought half. So what we've got here going on is the farmer is doing an exchange on $2.5 million worth of property. He buys 3 properties, each one to suit the needs and wants of his children. And in this case, I set up the example, so I just made the math even. Who knows what the values of these properties will be one day in the future? But each kid knows that they have the responsibility to run and administer the property. And what they're looking at, they're not getting their inheritance in advance, but they're getting the opportunity to manage what's going to be theirs one day in the future. And the farmer is going to get the rent from the office, the rent from the land, and the rent from the veterinary clinic. And he no longer has headaches. His kids are paying the rent. He's got $250,000 from the sale of his home, and the IRS got 0. So this is one of those, I like to describe it as kind of a home run transaction. If you can put all of this together, this is just a tremendous transaction. Of course, in today's environment, properties sell quickly. It's hard to do it. But this sort of pulls together a lot of the concepts, including when I started talking about the primary residence and the interplay between a primary residence and investment property. Okay, let's see if I can pause again for a second. Let's see if I've got a couple of questions. Taxes calculated. All righty. Okay. Dana, I'm not sure if you're on board. I see you're muted. Questions at the moment? Dana, how are we doing?
We're doing great. I don't see anybody have any questions. I want to know where we can find these farmers that have $2.5 million.
So when we had this slide created, and it's going to go back 25 years, give or take, I said, well, I'm in Atlanta. I don't know if I'll ever have a farmer with a transaction where part of what they sell is their residence. Within 6 months, I was working on a transaction in Gwinnett County, which is metro Atlanta. But in some section of Gwinnett County, somebody had a farm activity going on. And lo and behold, I had the perfect example. These days, there are fewer and fewer farms. I agree. They're not on every street corner, but it's an example of being able to put a lot of pieces together.
Absolutely. Okay, we've got a written question, and then I have a question. The question is, can you discuss what's considered income for purposes of, capital gains tax brackets? My client is retired and receives a federal pension. He also gets a monthly payment of his choice from his IRA. Are the funds from the IRA account counted as income?
Let me take that and just hit a couple of high spots. Funds from an IRA may be taxable unless it's a Roth IRA, in which case the money comes out tax-free. So the IRA may be taxable. With respect to pension, I don't know the status on the taxability of that. As far as capital gains tax, the reason people refer to capital gains tax is that it's not the same as earned income. It's not earned in the sense of commission or wages and salaries. It's gain that it's not totally passive, but it's based on capital that you invested either in stocks, like in the stock market, or real estate. When you go to sell that capital asset, the taxation of it gets treated differently, and it's got a slightly favorable tax bracket. So in our world, I would say typically rental houses will qualify for capital gains treatment, which means you're not paying as much when you sell a rental house as you would pay if you made the same money in your day job, in a commission income situation or in a salary situation.
All right, John, a couple more questions. In your last example, are there any checks and balances to determine that the children are actually paying rent? Another question is to clarify. So there is no time limit on how long you can own a tax deferred property you bought in a 1031 exchange. And another question, when selling a primary residence where proceeds will create a tax consequence, can those taxable proceeds be deferred if used to purchase an investment property?
Okay. Let me take the first one. We've got this scenario where the farmer bought 3 properties and the kids were all supposed to pay rent. The farmer is the landlord. And if the kids don't pay the rent, then the farmer's got to think about whether he is making a gift to the kids and whether those have tax consequences, or potentially, if your tenant's not paying rent, you can evict them. Of course, today that might take 2 years, but the only checks and balances will be looked at in the relationship between the landlord and the tenant. In this case, if somebody's about to give me a $750,000 property, I want to make darn sure that I pay the rent, because the farmer, if he's still alive, he can write the kid out of his will. So that's probably the hammer that I would look at. Time limit on how long you can own a tax deferred property you bought in an exchange. The ultimate strategy, the really ultimate long game strategy in a 1031 exchange, you build your portfolio with rental houses, you sell them when you get ready, you exchange into something else. But at the end of the day, if you pass away holding a portfolio of highly appreciated property, and the property passes to your kids, you've owned the properties forever, you've never paid capital gains tax, and under today's tax laws, your kids will inherit the property. They could sell the properties the next day and they would pay no capital gains tax. That step up in basis, that rule may get changed based on conversation that the current administration is having. But right now, you can own your replacement property indefinitely. You can own it till you die and never pay the taxes. When selling a residence and you've got a profit over the 250 or $500,000 exclusion, can you defer the gain by investing in a replacement property? Unfortunately, you cannot. You cannot crisscross the dollars in the residence and the investment property transactions. The way you have to massage your way around crisscrossing, if you will, is do a 1031 on investment property, keep it as an investment for a couple of years, and one day move into it. The tax treatment on the sale of property is going to be based on how a taxpayer is using the property in and around the time of the sale. And then clarification, capital gains tax based on your income, trying to determine if a client can avoid paying capital gains tax based on an income of less than 40,000. Here's the situation. If a client has a small income, an income under 40,000, they may not have to pay any capital gains tax. But if they sell a rental property, if they have a base income of 40 and they go sell that $250,000 rental house and the total gain is 150, that 150 gets added to the 40. So their total income is 190. And then they're going to be paying capital gains tax at the 15% rate. I generally don't see 1031 exchanges where people do not have to pay a tax, because a 1031 exchange by definition is coming from somebody who has a gain on a property, and a small gain of $5,000 to $10,000 typically is not going to be worth doing an exchange. Spend $1,000 to save a few thousand. Typically, we don't see that. Usually the properties we see have gains that are substantial, 50, 75, 100, 300, a million or more. And all of that adds to your base income when determining your capital gains bracket.
John, I have a question. Do you have any advice or suggestions, or what have you seen in the past that has been effective for agents to market themselves to get these kinds of clients whom they can help by introducing this 1031 tax exchange idea and help these clients with that? What kinds of marketing, advertising, keywords, what kinds of things have you seen that could be effective in helping our agents attract these people?
Dana, that's a great question. And I'll tell you a little analogy that I use. And I want to thank the world of residential real estate agents, because y'all collectively have made me a better marketer, because I see the marketing materials you send me. You send me postcards, you send me letters, you send me announcements when you've listed a house on my street. You send me magnets, you send me football schedules, you send me all kinds of material because your goal is to keep your name in front of me. How would you like to send me a postcard or a letter that says, would you like to sell your property? And then here in bold letters, and pay no taxes? Call me. You're not trying to tell them all about 1031 exchange on that postcard or that letter or magnet or email or whatever technique you want to use. All the postcards, letters, emails, and magnets are designed to do is to ring your phone. And you can say, oh yes, I'm an expert in selling real estate in your community. I understand you've got a property on such and such street. And your client, your potential client's going to say, what do you mean pay no taxes? Well, I see that the property you want to sell is not the same as your home address. If that's an investment property, you could sell it and do a 1031 exchange. And they're going to say, what's that? Well, you've already got your 4 two-word phrases lined up. Tax savings, investment property, time period equal or greater. But the idea is to tickle their thinking to get them to call you. So whichever marketing channel you think might be good for you. I used to talk about all the magnets I got. Of course, magnets don't stick to stainless refrigerators, right? But I kept magnets on the file cabinet in my office. And each magnet I got, I would stack them up. And Dana, it was your goal to be the top magnet on the day that I decided to list and sell my property, because I'm looking at the magnets saying, oh yeah, these people have sent me their information. It would be convenient to call them. So however you reach out and touch your farm market, your territory, consider reaching the people whose address, their home address, is different than the property address. That's all in the tax records. And you got to stratify for that. It's a little bit of a process, but you have a new way to reach them other than just saying, I listed and sold a house on your street, or I was the top agent in my board last year. You're going to say, pay no taxes? Question mark? Ask me how. And it's just a different way of getting somebody to consider to picking up the phone and calling you to potentially list their property. So I've found that one to be, I get heads nodding in classrooms occasionally. Just a quick thought there. Let's
We've
see.
got,
I've got
another question.
Mhm.
Oops, I lost it now. Time. What are the time limits again for use of, say, a vacation property like a beach condo if it's rented all year, but the owner uses it during the year?
Question on the vacation property. There's a 2-week period. The baseline is the owner can use it for 2 weeks for each year for the 2 years following the exchange. And I'll be glad to send that flyer. Dana, I'll shoot you an email when we wrap up
Okay.
with our vacation property flyer. That's a popular question we get a lot of. And the 2-week is the baseline. You tweak that a little bit with the days that you spend maintaining it and all of that.
One more question. Is it true we have 2 years to file and make capital gains taxes to the IRS? And will they allow you to make a payment plan, or do they require all the tax all at once?
Well, the IRS wants all the money at once. However, you can apply to get a payment plan. If you sell a property this year, your taxes will come due April 15th of next year. But if you think your client is going to need something in the way of a payment plan, you want to have your client talking to their tax preparer. You know, and I don't know who the question came from, if it's you personally, you want to talk to whoever is doing your taxes. I'm not familiar with the logistics of payment plans, but I know they exist. You can Google IRS payment plan and read some more about it. Dana, I want to touch one more topic. I know we're up against our time. I want to touch one more topic. Y'all have got the slides for this. I will tell you, when I do this in the classroom, I turn the projector off because it's a complex topic. But when we talk about exchanges, we're talking about a sequence of selling a property, putting the funds in escrow, and then buying a replacement property. And every once in a while, your client will find a killer deal replacement property and have to buy it before they've sold the relinquished property. And the question is, can you do a reverse exchange? Y'all have probably seen today that I like to say yes to as many questions as I can. There is a technique called a reverse exchange. It's where you acquire the replacement property before you've sold the relinquished property. The IRS has a reverse safe harbor procedure. It is valid, it is permitted. It takes financial strength, because think about it. You've got to have the strength to buy the replacement property before you have gotten rid of the relinquished, before you have the funds available. So if your client is thinking about doing this transaction, so to speak, backwards, it is allowed, it is permitted, it does take financial strength, and it's more complex, it's more expensive. And I'd be glad to talk to somebody, offline. It wasn't my goal to teach y'all all about reverses today. It was my goal to introduce it as we also wrap up. And I'm not even going to bring the slides back up. The last slide, and this goes back to Dana's question on marketing. There are a list of reasons to exchange, whether it's changing the use of the property from, say, residential to commercial or residential to raw land, relocating, another marketing technique. If you've got clients that have moved to your part of town and they moved from out of state, if you've ever learned that they have property back where they came from, Texas, Tennessee, wherever it may be, ask them if they'd like to get rid of the rental property in the old state, and you'd help them buy replacement property here. Another use of the 1031 exchange. Diversification, selling one property and buying multiple is a way to diversify. We saw that with the family farm. Consolidation, and these are all things that you can put in some of your farm, in your marketing communications. Consolidations, tired of tenants, roll 3 properties together and buy 1 replacement. And finally, the real winner that everybody likes to start thinking about is retirement planning. What happens if I sell 3 or 5 rental houses and I buy the place in the mountains? Can I move up there? The answer, of course, is sure. In a couple of years after you've rented it, then you potentially have bought your retirement home using, in part, some of the IRS's money. So Yeah, I have rambled on for 3 hours talking about taxes. Dana, your group has been great. I appreciate all the questions and y'all's participation. I will send you a couple of attachments, Dana, by email and let you get them out to your folks. And y'all have got my information. If I can be of help, you know what we do. We serve as the intermediary. Thank you for letting me talk about taxes, and thank you for letting me steal a few more minutes from you this afternoon.
Absolutely, John. This class was fantastic. Just a wealth of information. You guys, I will get your email addresses from when you registered, and the additional information that John sends, I will email to everybody. And I'm going to put on the screen one more time before you leave, if you have not already done so. Type in your name, email address, and license number. And I believe I've got one person on by phone, so I need your phone number as well. There are hyperlinks there to the handouts. And if you go to that web address, eagentweb.com, select training videos, you will also find the documents there. But I will email them to everybody. Give me a couple days. And I have recorded this, so I will get the video up in a few days as well. Any other questions, everybody? Phenomenal, John. Great to see you as always.
Thank you.
Thank you, Andrew. Dana, I look forward to seeing you in person sometime soon.
All right, I am going to take the coast back. All right. All right, everybody, thank you. Go be a blessing with your real estate license. There are lots of people that need your help, and you have now lots of ideas. And again, another tool in your arsenal to go be a blessing with your real estate license to the public. All right, thank you, everybody.
Thank you, Dana.
Thank you, John.